in Capital Advisors. Anton, it's good to see you. You've made a lot of great cases for owning some of these regional banks over the years. Are you extremely frustrated by this? Do you view it as just another headwind that is also going to pass, or are bank investors kind of rightly losing their patience here?
Well, I mean, I'm a believer in a V-shaped recovery. So the market's supposed to be a forward-looking instrument, and it's supposed to be looking forward out, 6 months, a year, 10 years, right? If you're going to compare the 10-year Treasury, I'd rather own bank stocks over 10 years than the 10-year Treasury. So, if you think about it, banks are going to benefit from the mortgage boom. There's no doubt about that. The consumer is going to benefit from lower mortgage costs. They're going to benefit from lower fuel costs. And, if you look at China, China's starting to come back. So this thing runs a course, and when it's done running its course, I think that latent demand is going to pick right up, and I think we're going right into a V. And here's the other point I think that's really important.
Sure.
If you're a U.S. manufacturer and you've gone through trade wars, and now you're going through this, and your supply chain isn't working so well, what are you going to do? I mean, when you get that opportunity, you're going to bring that supply chain back here. So I really think places like the Midwest are going to be a major beneficiary when this dust settles, and this dust will settle. And oh, by the way, we're all behaving in a way that none of us have behaved before, in that whether we're elbow bumping or foot tapping or washing our hands 50 times a day, there's going to be less cases of things like the flu spreading around because we're all, hypersensitive to taking care of ourselves and making sure we don't affect each other. And I think that is a tremendous change in our behavior, and I think it's going to lead less people to be out of work. So over time, I think this is actually a big change, and it's a positive no one's really talked about.
Yeah, I see another positive you think could also come of this is a baby boom as people are quarantined at home. Let's leave that aside for just a second. So going back to the bank stocks and the valuations, Anton, is there, we spoke with an analyst the other day who said when you get a decline in yields like we've seen, we're talking about maybe a 12% hit to forward earnings. Kind of what are the numbers here? Because it was one thing to fall as low as 1.3%. That seems like ancient history. We're below 0.9% now. How much is that going to, how much is the earnings power this year now going to drop because of that?
Well, I mean, I think there's multiple questions on earnings power. Obviously, the first one is where do treasuries settle, right? I mean, they're going to settle somewhere. And, if you believe in a V-shaped recovery, I do, treasury rates are going to be a fair bit higher. I know JP Morgan's one of the firms that talks about treasury rates being substantially higher in the latter part of the year. So, I don't think, treasury rates are necessarily going to hurt the banks tremendously from where they were in early January. If you then go on to short-term rates, look, the Fed short-term cut is probably going to impact bank earnings by, 6-7% on an NII basis. And obviously the mortgage are going to, really make up for some of that in the very, very short term. So banks that are mortgage heavy are going to do quite well. It really does depend on the V-shaped recovery, the back half of the year, and where do rates actually end up. Because to take rates at a static thing and say, hey, 0.9, 0.85, 0.5, whatever it is where earnings are going to be. You've got to hold them steady.
Right.
And assets don't reprice every day; they reprice over time. So look, at the end of the day, I'd like to see the Fed expand its balance sheet on the short end, not the long end. And I think we've seen enough cuts. And when people say the central banks are out of bullets, they're completely wrong. I once put that to a Fed governor, and he laughed at me, and he said, as long as the printing presses don't run out of ink, we're not out of bullets. And oh, by the way, the U.S. Fed has never bought equities like many of the central banks around the world have. That's certainly another massive tool that we could use. As a prior guest said, it's time for our government to get to work, cross the aisle, get some stimulus that's fiscal. It's time for the Germans to do the same darn thing. And I think we're going to come through this. We're going to come through this quite strongly.
But Anton, my final big picture question, because I actually see you describing two different scenarios. On the one hand, a positive scenario, because like you said, maybe there's better health long term, maybe there's a population boom, maybe there's a V-shaped recovery. On the other hand, undeniably, we are way closer, the U.S. is now, to a Japan or Europe style zombified economy than we ever thought we were going to be. So we're staring down a future now that looks uncomfortably close to the experiences that they're going through. Are we going to get zombified too? Is our 10-year going to zero, like it or not here? I mean, I'd like to be as constructive as you are, but all the signs now to me point towards those episodes and us repeating them, which would be terrible for financials. That's what Jeff Gundlach just said last hour. I mean, this is financial repression all over again if this is the way we're headed.
Yeah, and I think that's where the Fed should rather expand their balance sheet than cut interest rates. Sure, that's helping some companies and helping some consumers, but you know, when I look at the growth prospects we had coming into January, when you look at some of the manufacturing, you look at PMI's numbers yesterday, and I expect a strong job number tomorrow morning. Yes, those are lagging indicators, but the economy wants to go. You know, a lot of regulations have been removed. I would not put our economy in a zombified state.
Right.
Maybe it is right now. Maybe people are hunkering down, but while they're home, they're still spending money. And when I look at long term, the U.S. economy does want to go. A lot of regulations have been removed. A lot of businesses want to go and want to run. And like I said, I think that we move a lot of manufacturing supply chain back to the United States. And I think that will really lead to a manufacturing rebirth in this country.
I hope so.
Yeah.
I'm going to take the glass half full. You know, with the market down about 1,000 today, I'm going with your glass half full point of view. Anton, it is great to see you on a day like this especially.
Pleasure.
Thanks for joining me. Anton Schutz, Menden Capital Advisors, recommending some of the banks here. Let's get a check on markets right now. Our low on the Dow was down 1,033. We're down 953 right now. That's a 3.5% drop. It's the worst performer. The S&P is down about 3.3%. It's down 105 points, 30.24, and all 11 sectors are lower, led by financials as we just discussed, energy, which we'll talk about next, and the industrials. As I mentioned, it's not just the banks that are down more than 4% today. Energy is too. It's really taken a beating. This after Sam Zell this morning said the massive drop in the energy sector isn't justified. Is he right? We'll dig into that next.
It's not a question of place. It's not a question of temperature. It's not a question of dedication. In fact, it's not a question at all.
Energy has to be better. It's our responsibility.
And our commitment to make it better.
For all of us.
Total, committed to better energy.
And its OPEC allies have reportedly failed to sway Russia to join them in further slashing oil output. That's according to Reuters, citing its OPEC sources. Riyadh is seeking additional production cuts of up to 1.5 million barrels per day, whilst extending current cuts until the end of the year. The coronavirus outbreak continues to weigh on global demand.
The Russians really are holding out more than usual this time around. Russia's also more comfortable with lower oil prices compared to the Saudis. So, I mean, look, this is, as I call, beyond politics, right? There is definitely stuff going on behind the scenes.
CNBC Events. The power of our newsroom live. In person. An exclusive invitation to connect. Seek out new ideas. New opportunities. Share your perspective. Spark your imagination. Join us. CNBCEvents.com.
I'm Seth Meyers, Ty Burrell, Susie Essman, and Late Night Dioramas.
I'm the best president who ever presidented.
And Biden won in states he didn't even visit.
Turns out it was a smart move to have him talk to voters as little as possible.
Tonight.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, Morgan Brennan, John Ford. Squawk Alley on CNBC.
as it did in the House yesterday, and then it would be able to move on to the president's desk. Now, earlier today, lawmakers had been briefed by administration officials on the status of the response to the outbreak. They were told that there could be 1 million test kits available in short order. This bill will provide not only federal agencies, but also state and local governments the money they need to purchase those kinds of kits. Again, the vote is still ongoing, but is expected to be a show of strong bipartisan support. Kelly.
Elon, thank you very much. Elon Moy on Capitol Hill with the latest there. I'll turn back to Jim Murio, sir, for a quick response, kind of your reaction to that news and put a button on it here.
No, I think it's great. Anytime we can see them working in a nonpartisan way, I think is wonderful. And sometimes it takes these sort of things to do that. I think that's encouraging. You talked about the Fed lowering rates again. And there's so many people out there, it's become fashionable to say, well, lowering rates doesn't help this virus. Yes, but it can help the economic impact of it. There's plenty of companies out there that are going to be affected greatly. Some companies that operate on very low margins and might not be able to withstand it. And a little extra boost from lending could be a very good thing. So I'm for them lowering rates in situations like this. What I'm not for is them not taking away the punch bowl when they should, which will probably be a couple months down the road.
Have you guys stocked up on, TP and everything else, Jim, at your house?
I have not. I'm not that much of a believer in this. And please, nobody trust me on this because I don't know anything. But I'm not that scared about it. Sorry.
No, just curious. Jim, we really appreciate it. Thank you, sir. Jim Murio out of the CME. Matt Cheslock is down at the New York Stock Exchange. That does it for the exchange today. See you on Power Lunch.
Kelly, thank you very much, and we'll see you over here in just a moment. Welcome, everybody, to Power Lunch. I'm Tyler Matheson, and we start with another major sell-off on Wall Street at this hour. As you see, the Dow is down almost 900 points. Stop me if you heard this before. Stocks are tanking as fear of the coronavirus front and center in investors' minds. Check out the Dow. The lows today down more than 1,000 points. Right now, down more than 900 following yesterday's huge relief rally. And that fear, of course, bleeding into the bond market as well. The 10-year yield hitting a fresh record low, breaking below 0.9%. That is a staggering move right now at 0.928, but it was lower than that earlier. And we now have about 177 cases of coronavirus in the United States as the CDC begins to roll out more testing across the country. Washington State dealing with the largest outbreak so far. Cases doubling in New York. We'll tell you how bad things could get as Power Lunch begins right now.
Thanks, Ty, and I'm Kelly Evans. We're all over this virus volatility for you today. Our team coverage of this market sell-off rolls on as coronavirus fears do grip Wall Street once again. Bob Bassani is tracking the action down at the NYSE for us. Rick Santelli watching these amazing moves in the bond market. Meg Terrell with the latest on the outbreak. And Steve Leisman digging into a potential credit crunch coming for corporate America. Bob, we start with you.
And the debate has always been for the last week or so, is this a short-term phenomenon for American businesses and specifically earnings, or is this a longer-term phenomenon we're going to be dealing with for several quarters? For today, the concerns about longer-term are definitely prevailing. Here's the three sectors that would be most affected here. Energy and industrials, all notably down here. Banks are also weak on top of that. You see gold rallying here. We're sitting near multi-year highs for gold. Notice China, this is the broad China market, is up. There's been hopes, been looking at maps indicating pollution levels are back up in China. Maybe people are going back to work. Okay, maybe that's a little bit of a hopeful sign here, but not if you look at this whole demand side. We're debating supply versus demand. Folks, look what's happening. These are new lows, new multi-year lows in all of these sectors. Royal Caribbean, Marriott, Delta, Live Nation, concerns about less participation in entertainment. Madison Square Garden also down as well. Just take a look at some of the banks as well. As you can see here, these are new 52-week lows here on all the big banks. These are big super regional banks, including Wells Fargo, all new lows. So why the chaos and what's going on? Remember, essentially we are debating whether or not there's going to be a recovery and what it's going to look like. Is it V? Is it L? Is it U? And nobody can answer this question right now. We don't have enough data. Indications over in China are hopeful. Europe is still a bit chaotic right now. That's sort of in the middle of the whole debate. As for the supply versus demand, forget about it, folks. This is both right now. It's a supply problem and a demand problem. Just ask those people that are in the entertainment business whether this is a demand problem or supply. They don't care. Guys, back to you.
All right, Bob, thank you very much. Let's go to the bond market now, where yields are just collapsing as the 10-year hits an all-time low. Rick Santelli live at the CME with more. Hi, Rick.
Hi, Tyler. Just looking at the yield curve today, and net change gives a lot of information. 2s are down 11, 5s are down 11. We're down 14 in 10s, 13 in 30s, so the curve has a bit of flattening because the drops are bigger in the long maturities. This has been the oddity. Mostly it's been steepening with short rates outpacing the drop of longer rates. 2-year note yields at their worst at 55 basis points. As you see on that chart, would have been the worst close since July of 2016. They're up a little. It really isn't going to change the comp. Intraday of 10s is alluded to by Tyler. 0.89, there it is on the right side of your chart. That is the low, at least for today. And how do you make a bounce to 1% look good? You start at 0.89. 1-year boons, they settle at minus 68, minus 71. Late August of last year was their all-time low close. We're within striking distance. Finally, the dollar index intraday. You see where it's trading? Right now, it is under a half a cent from unchanged on the year, which was 86.39, and it would be the first time in 2020 we challenged that level. Tyler, back to you.
Rick, thank you very much. Well, the major averages seeing their second steep drop in 3 days after yesterday's big rally, the second biggest point gain for the Dow ever after Monday's. The Dow falling back into correction territory right now, down more than 10% from recent highs. So we're heading back to Friday's lows. That's the question for Jason Pride, Chief Investment Officer of Private Wealth for Glenmead, which is more than $40 billion in assets under management. And Tim Seymour will join us for the hour. He's the CIO of Seymour Asset Management and a CNBC fast money trader. Welcome to both of you. Jason, let me start with you. What do you think the headwind is here for global GDP and potentially corporate earnings?
Sure, Tyler. So, we have to recognize first and foremost that you could basically drive a truck between the upside and downside case scenarios here because nobody has a very good beat on how long is going to last per region and how governments, corporations, or individuals are going to react. Now, having said that, if fair heads prevail through this pattern and we try to minimize damage while also trying to deal with the disease in ways that we've dealt with other outbreaks in the past, we should experience somewhere around a 0.5% to 1% headwind to global GDP growth. And that's based on assuming that China took its hit, and that is what it is, and it has to pass through the system, and everybody else that's affected takes a smaller but still notable hit along the way in trying to rectify the situation and slow the spread of the disease. That is part of what the markets are reflecting. I would argue that markets may be over-reflecting a bigger chance of bigger downside at this point in time, but time will tell on that as we process along.
Tim, do those numbers sound in the ballpark to you? A little too modest? A little too grave? What do you think?
No, I think for first quarter GDP, if you look to the main economists on the street, where people have cut down. UBS is down to 0.06. You've seen people cut it to the bone. Bruce Kasman at JP Morgan, I think, is pretty much right down the middle at 1.2. The bottom line here is we had risk to global growth before the coronavirus. So if you think about Europe's economy, think about the biggest economy in Europe, which is GDP, and the export route into China, what was happening with the trade war. PMIs around the world throughout the fall were essentially caving, and then we were wondering where we were starting to see a little bit of a bottom. We were. The dynamic here isn't great, and I think that's what equities should be grappling with, because if you think about where we were on those lows of October 3rd, before the markets then went up 19%, a lot of that was Fed liquidity. And I think markets would have been grappling with the same things we're grappling with now with the coronavirus.
And Jason, in terms of liquidity, let me just go back to the question about whether providing more liquidity, acting as the lender of last resort, lowering the rate, are all of these things you think fundamentally going to help the U.S. economy, or do they risk doing more harm than good?
So number one is I'd say there's two problems to fix. One, which the Fed and liquidity has no solution to whatsoever, and that's the actual outbreak of the disease and any ramifications that come from that and any shutdowns that governments have to do regionally and otherwise. The economic impact of that is going to be what it is, number one. But number two, what they're trying to avoid is a seizure of financial markets and credit markets that could be a second-order impact here. With the central bank stepping in, they try to avoid that situation and try to keep this from spiraling to the downside out of control and having kind of second-order knock-on effects that take this down further. Long-term impact, look, low rates, ongoing fiscal and monetary stimulus. Eventually, we have to get out of that trap at some point in time. We need it right now at this instant. What they need to do is once things get back online, they have to take that away at a reasonably fair pace in order to get us back to normal operation down the road. It's just, we're not near that right now.
Do you see, Tim, signs of kind of financial panic, the kind of crunch-esque situation that he's describing? I mean, we see empty store shelves. We see people trying to get their hands on toiletries and supplies. Do you see a financial market analogy there?
Well, so, I mean, the panic around getting supplies is largely things we've seen. This is an extreme version of that around macro weather and certain events. I think the financial markets are, you can make an argument that the bond market's panicking. The bond market is certainly forcing the Fed here. And I would argue, actually, that rates this low is detrimental to the economy. And this creates tighter financial conditions, not looser.
Why?
Because ultimately, first of all, banks start to reel in credit. And at these rates aren't moving lower because of people are buying debt out of confidence in the growth story. They're going lower as a safe haven. So the credit dynamic, and if it was 9 months ago, we were talking about this tranche of kind of BBB plus. That was really that concern of going to junk, or BBB minus, I should say. So, that big part of the credit community, and we've actually seen credit spreads be reasonably well behaved, but we've just started to see companies give you their guidance, and the sectors that we may talk about later on this show are ones that they're a lot closer to credit stress than I think people know.
Energy being one of them, yeah.
So, Jason, here we are in the first week in March. In the first week in April, a month from now, corporations are going to start reporting their earnings. Would you expect that would be a time where we might take another major leg down as both the actual reports and the forecasts get revised?
So I think I have to go back to my earlier statement, is that the range of expectations is really, really wide on this. I would argue that, we started the year at 9.4% growth for the S&P 500 expectations for 2020. We're already knocked back to about 7% as companies have already initially started to kind of guide lower, or analysts have already started ratcheting down numbers. I would expect we probably end up seeing somewhere around 0 to 5% growth for 2020 as being kind of ultimate results. So, but I think markets are already kind of baking that in. The question that creates the further leg down is if the downside case gets realized at this point in time, meaning prolonged virus contagion and outbreak and or second order impacts on the market. Those are not our base cases, but they are in the realm of possibility, and we need to be aware of them as investors.
What is the risk, Tim? Jason sort of alluded to it, that the financial system could seize up. This is not a financial crisis right now, that I can tell, like 2008 was. But are there risks? It's not even close.
It's not even close.
It has no,
especially in terms of
completely different origin.
The sovereign balance sheet's in a very different place. It's not in a great place. The corporate balance sheet's in a quite good place. In fact, the earnings support for the market for the last couple of years has been buybacks and the ability to actually raise debt at low rates and do other things with it. If you look at the balance sheet of the banks, the money center banks have never had better balance sheets. Their risk models have been reeled in dramatically. I think a lot of this is market positioning. I think a lot of this is we came into this with $400 billion of Fed balance sheet that was thrown at the market, which correlated 1-to-1 in terms of the S&P move. You have an expectation. Bob Pisani at the start of the segment talked about, are we V, are we U, are we L-shaped recovery? I think he was talking economic. I think people think that that's the market. I think people think the market, after December 2018, a lot of people were burned sitting on the sidelines, and it was a V-shaped recovery, and it was a place where you should have been buying with both hands. And I'm not saying people should run for the hills. I'm saying that you can argue we're in the same environment, and even though there are great companies right now that I think are worth owning, and I'm sure we'll talk about them.
You want to mention a couple and then we'll move on?
Yeah, I mean, Disney is a company to me that was re-rating on the back of essentially their Disney Plus service, has a studio business that's been cranking for a couple of years now, and yeah, I understand that their theme park and their consumer experiences business is 38% of their revenue line, but in the short to medium term, that's a headwind for a company that we were re-rating and actually using a hybrid multiple on all these other drivers. Disney is trading inside of where it went before it re-rated, so there's a good example.
All right, and Tim, like you said, is sticking around for the hour. Jason, thanks so much for joining us. We appreciate it. Jason Pride of Glen.
Thanks for having me.
Well, our next guest says there are 3 scenarios for what happens next as the number of coronavirus cases climbs in the U.S. and around the world. Here to break down what the global economic fallout could look like is Robert Kahn. He's Eurasia Group's Director of Global Strategy. Robert, it's great to see you. You have the benign, serious, and severe. And before we dig into what those are, where are we? Which one are we right now?
Well, we don't know, for the reasons your panel's been talking about. We're still hopeful that a benign scenario could play out, but I think we're increasingly worried about the more severe scenarios, and that's why we set out to lay out these scenarios and try and differentiate and talk about the critical role of policy, as well as the virus itself. Differentiate. We started with the science, by the way, in doing these scenarios. It really does depend, in our view, on when the peak in cases occurs. In the benign scenario, if the frontline states, the China, South Korea, Italy, make good progress in coming weeks in containing the virus, and the U.S. and others are aggressively going after it, we are still hopeful, we're still possible that we could end up with a peak in the growth in cases in the next 6 weeks or so. And certainly we believe that in that scenario, you do get the V-shaped recovery, you do get a pretty rapid bounce back in growth, you do get some recovery spending as people go back to work and go back to the theaters. But as I say, we're less and less optimistic that that indeed is going to be what happens, and more concerned about what we call a serious scenario.
Okay.
In the serious scenario, we don't see a peak in the new cases and the spread of this disease until the middle of the year, perhaps July. And that leads to profoundly different outcomes for the global economy, because with a virus and a pandemic that is of that length and duration, the damage to supply chains and to the balance sheets of our corporations and households is far more severe. And in that case, we're far less comfortable with a scenario of a quick or rapid bounce back. In fact, in that scenario, we see zero global growth through the middle of the year and only a gradual recovery in the second half. And that would leave, as I say, lasting damage that really will put the pressure not just on the central banks, where we're focused now, but on the fiscal authorities to come in, provide not just credit facilities, but to make fundamental decisions about who to fail and who to bail. You know, how you provide support for the industries that are being badly damaged by the virus, or simply were overextended and got into trouble given this shock.
So, Robert, do you take any comfort from the reports that the disease or new cases of the disease in China seem to have moderated very dramatically in the past week or so? In other words, they are having sort of lower lows most days in the discovery of new cases. Is that encouraging to you? And if so, how much?
Well, it's certainly encouraging, but I have pretty fat tails in the distribution. Certainly, I'm not a scientist. I'm not a medical professional. I don't even play one on TV. But but we do listen to them very carefully, and the news out of China has been good. I would emphasize, and it's a theme that comes through all our scenarios, particularly the more serious ones, the serious and the severe scenario, that policymakers face this trade-off between a very hard containment strategy and one that perhaps is more focused on identification, tracing, and testing, and gives a higher priority to reanimating the economy once you feel like you got a handle on things. Containment has its advocates, but it does come at a very high economic cost, and we see the Chinese struggling, I think, to get people back to work where they've decided to do so. So, I think our basic view at Eurasia Group is to be very cautious in making any firm medical judgments about the course of the virus at this stage. It's extraordinarily uncertain.
Understandably, so let's talk about central bank policy, because people are immediately looking to that for a bailout here before we even know how severe this is. Does that make sense to you?
Yeah, central banks are going to be the front line. Obviously, they have limited ammunition in some sense, given where we're starting from, but I had no problem with the Fed cutting interest rates 50 points to bolster demand. Yes, it doesn't really address the supply shock element of this, but it does add additional support to demand the economy, and the combination of supply and demand is unavoidable here. I wish it had been a little better coordinated, but we're living in a G0 world where I think central banks and finance ministries are going to always going to be, in this sense, likely to be acting in a seemingly independent or less coordinated fashion. I think, though, pretty soon we're going to really be turning the focus away from interest rate cuts and more to the credit issues. Perhaps as early as next week, when we get in England, when we get in the UK, we get a new budget, and we may get some action from the Bank of England. I think we've also gotten messages out of South Korea and Japan. The credit may be really the next frontier for policy action, and the ECB really can't do much on interest rates, I don't think. There, too, some sort of term facility extension is probably where we go. So I think, once again, the shift will come to providing liquidity from central banks. Now, just one caution on that. When central banks do it, they do it based on the idea that these are solvent entities that they are lending to on good collateral. And that's a great plan as long as you're comfortable on solvency. So returning once again to our scenarios, if you really believe the virus will peak in the next 6 weeks or so, and you're in that benign scenario, your liquidity approach works pretty well. But if we're talking about a peak that only comes in July or later, then the solvency questions are going to be front and center. And ultimately, then, we're going to have to pivot to governments and to fiscal authorities to make the call.
All right, Robert, thanks for your time today. Robert Kahn of the Eurasia Group with some different possibilities for the outlook from here.
Well, the coronavirus, of course, the trigger for virtually all of the recent market mayhem. Global cases exceeding 95,000 now, deaths reaching more than 3,200, and there are 11 deaths and 177 confirmed cases here in the United States. Meg Terrell has more on the latest outbreak.
Well, hey, Tyler, the numbers here are continuing to climb, and with expanding testing capacity, experts expect them to continue to do so. Today, a doubling of cases in New York to 22, 8 tied to the Westchester case identified earlier this week. New cases being reported in New Jersey and Tennessee as well. In Europe, more than 4,000 cases, with Italy the largest, but numbers in Germany, France, and Spain climbing as well. Italy's ordered schools closed, and across the globe, we're seeing India and Iran also closing schools. The United Nations notes more than 290 million students are out of school due to COVID-19, calling the global scale and speed of the current educational disruption unparalleled. In Seattle and King County, Washington, with at least 31 cases, recommendations for those at risk to consider staying home and away from large groups of people as much as possible. Those at higher risk include people aged 60 and older, those with underlying health conditions or weakened immune systems, and pregnant women. Guys?
You know, one question on the testing, which is now more widely available. As I understood, and as doctors had communicated to us, at first, if you even wanted to be tested, you had to prove you had been in contact with somebody who had been to one of these really affected regions and that you had certain symptoms. So it was a high barrier to even getting tested. How low is the barrier now? How much more available are these kits, and are they consistent in state to state?
Well, the guidelines now are to make this available to anybody who wants to have a test with a doctor's orders. However, the availability of testing is still coming online, so you're probably not going to be able to walk into your doctor's office and demand a test and be able to get one. These are getting rolled out to public health labs. Commercial companies are going to start coming online next week. We heard from Quest Diagnostics today. Their testing is going to start on Monday. So capacity is expanding, but it certainly isn't up to the level that they want it to be at this very moment.
You asked a very interesting question last night. I'm not sure we got the answer, and that is, why has the mortality rate been so much higher in Italy than it has been in South Korea, where there are actually more cases?
Yeah.
What's the difference here?
Well, it's something I've been digging into today with epidemiologists, and really what seems to be happening is that in South Korea, they're doing tremendous amounts of testing. 10,000 tests a day. They've tested more than 140,000 people at this point. So they are probably picking up more mild cases. In Italy, we do understand that testing is pretty extensive as well, but the death rate there may actually speak to some of the underlying conditions and risk factors that put people at risk for severe disease. There's an aging population there that this seems to be hitting hard, and those are the people who are at risk for severe disease and death from COVID-19.
Wow,
Thank you so much.
Yeah, difference between Italy and South Korea. Big things. Worries about the spread of coronavirus and possible supply chain disruptions have people flocking to grocery stores to stock up on daily essentials. Take a look at these pictures from our next guest who visited a Costco in Wayne, New Jersey. Been to that one over the weekend. Yeah, found
So am I.
So you're the one that cleaned up. Thanks a lot.
It wasn't me. Yeah, now we have nowhere to go. Anyway, they found, and everyone's taking the baby wipes. Anyway, they found empty shelves like these throughout the store, and the run has helped lift stocks like Kroger, which also reported earnings this morning and is soaring. And Costco, which is higher in the past week amid the sell-off, and has earnings after the bell today, we should mention. Let's bring on Rupesh Parikh for more. He's managing director and senior analyst at Oppenheimer. Rupesh, good to see you. And first of all, can both Kroger and Costco cope with this level of demand for the foreseeable future?
Yeah, I think they can. So I was actually at Costco the past few days, and compared to the weekend, they actually had better in stock. So bottled orders, the toilet paper. So I think Costco is handling their supply chain demands well. And then for Kroger, I would say the same thing. You know, as you give these companies time, they are able to restock their shelves. So I would expect the out of stocks to continue to improve in coming days.
Yeah, so I guess the question goes back to kind of the long-term benefit that these stocks might see. It's understandable there'd be kind of a one-time re-rating as people say, you know what, and by the way, they have some backing by Berkshire now, Kroger does, so, and Costco's been one of the better performers. But is there a structural change in the value of these businesses because of coronavirus?
Yeah, I would say there isn't a structural change. It is more of a temporary benefit. But what I think you've seen the last couple of days is investors are seeking more safety. And I would say both Kroger and Costco are more beneficiaries of that flight to safety. And if you think of earnings for both chains, if you start to see people staying home at more, especially a chain like Kroger, they would benefit from more in-home consumption. And, you know, restaurants would get hurt in that type of scenario.
Hey, Rupesh, it's Tim. And I think you may have partially answered the question because you talked about how maybe it's just a safety trade here. But if you think about Costco and Walmart and even Target to a lesser extent, these are stocks that have re-rated massively over the last 12 to 18 months. And again, there was a little bit more of an earnings defensive play to them. But Kroger today, announced, excellent gross margins. And today's numbers had nothing to do with coronavirus. So talk about that. Is there a reason why these companies actually should be trading near the top of a range independent of the coronavirus?
Yeah, so coronavirus, you're absolutely right. I mean, it didn't really have much of an impact on Kroger's report. They did indicate in February their trends improved modestly. And I think coronavirus will have a bigger impact for Kroger in March and going forward. And then for Costco, same thing. I mean, their report that they're going to report tonight is not going to have any benefits from coronavirus. But then their February sales report, which they also report, I think you will see a significant improvement in their comps for the month of February.
Are whatever gains we're seeing in these stocks, Rupesh, sustainable as we look at the Dow now down 1,000 points again?
I think these names, you'll see continued outperformance, but I would argue, as you look out 12 to 18 months, these coronavirus-related gains would start to dissipate. As we look at what's happening right now, you're going to see a temporary benefit for maybe a few weeks, and then, as you look forward, you may actually start to see a give back. As if you're stocking up on toilet paper right now, you're probably not going to go back to the store and buy more toilet paper in the next couple of weeks. So I think it is definitely pulling forward demand.
What other retailers are in the category of ones that might benefit from what's going on right now?
Yeah, so in my coverage, I would say BJ's Wholesale Club, which also reported this morning, they would be a beneficiary. Sprouts Farmers Market as well. And then in the dollar store channel, a company like Dollar General, which is essentially a grocer, more than 75% of their business is in the grocery category. They could also see a nice lift related to the coronavirus panic buying.
All right, Rupesh, thank you very much. We appreciate it. Rupesh Parikh, thank you. And for more on travel stocks, let's send it over to Seema Modi for today's edition of Trading Nation.
Thank you, Tyler. Travel stocks deep in the red today. Some of the worst performers on the S&P 500. Cruise lines taking the brunt of the pain as a Carnival Grand Princess ship is held off the coast of San Francisco with some passengers displaying flu-like symptoms. The stock now down as much as 50% just this year as the coronavirus spread intensifies. So is this group a no-touch on account of the outbreak, or could there be opportunity? Mark Newton of Newton Advisors, Gina Sanchez of Chantico Global joining me for Trading Nation today. And Gina, you look at the price to earnings ratios of these cruise lines and even some of the hotels, you could say they look compelling.
They do, but I think until we understand whether or not this virus is contained, when in doubt, stay out. That's kind of my view right now. We don't know where this goes, and we still need to figure out what the bottom looks like. And the cruise industry, airline industry, hotel industry, they're not going to be able to recoup this later. These are probably going to be losses that they can't recoup. And, for some places like the airline industry, that is going to put them back into non-profitability. So, I don't know that anything is really attractive right now.
Mark, do you agree? If you look at a name like Carnival, headed for its biggest one-day drop since 2009, what does the chart tell you?
Yeah, technically these stocks still look like an area to avoid in the short run. I mean, we've seen some very heavy volume on the declines. A lot of them are broken down. Stocks like Carnival are down over 60% just since the highs were made back in January 2018, and now it's right near 28. So that's really the lowest level we've seen since 2011. It's almost a 10-year low that's being made right now. So very much a steep drop. Oversold does not necessarily mean buy. Technically, it's akin to trying to putt a golf ball down a flight of marble stairs and get it to stop before the bottom. Okay, it's just very, very difficult. You take a look at the Dow Jones transports, and you see the damage that's been done in a lot of these airline stocks as well. And so, this continues to be a very weak group. We've actually broken the uptrend from 2018 and undercut the entire area of lows from last summer. So, yes, oversold, but we need to see some evidence of stabilization. And until that happens, particularly if the stocks are declining because of the corona, which doesn't seem to be contained, but if anything, growing in many countries, it's really wise to step aside and let this group stabilize.
Yeah, well, you could point out back during SARS in 2002, travel rebounded within 2 months after that was contained. Mark and Gina, we'll leave the conversation there. For more Trading Nation, head to our website or follow us on Twitter at Trading Nation. Kelly, back to you.
Okay, Seema, thank you very much, Seema Modi. For more on the travel stocks, let's look at the airlines, which are also getting crushed today. Now, the face a $113 billion hit from coronavirus. You can see American Airlines shares are down 10%, but even the ARCA airline index is down 7.5%. Phil LeBeau is in D.C., where airline executives are meeting to discuss the growing risks. And Phil, a lot of concern out there.
Absolutely, Kelly, because nobody's quite sure how long this fall-off in bookings will last for the airline industry. The airlines, by the way, as you take a look at the Dow Jones transports, the big component within the transports that's driving it down, now hitting bear market levels, it's the airlines. Whether it's talking about Southwest or American United, look, they're all down today, a substantial percentage, and that's because no one's quite sure what's going to happen with bookings, and therefore you're seeing schedule cuts from a number of the airlines. You mentioned the potential global cost impact. Let me state this again, how much it has changed since February 12th. Back then, the International Air Transport Association said it's almost $30 billion. That's worldwide what the impact would be because of coronavirus. Today, they upped it to $113 billion, potentially. That's the potential impact. Earlier today, here in Washington, we had a chance to catch up with Stan Deal, who runs Boeing Commercial Airplanes. And we put the question to him, as airlines are dealing with this fall-off in orders and the financial hit, will it impact future orders? Here's what he had to say.
Right now, it's a short-term effect. Airlines are taking response, putting airplanes on the ground and watching the situation. Long-term, though, we see that the demand will still be there.
You take a look at shares of Southwest. Remember, today Southwest put out its quarterly guidance. It's 8K, and they said, you know what? We think revenue is going to fall off between $200 and $300 million in the first quarter. I was just talking with Gary Kelly, the CEO of Southwest Airlines. He said, look, we're looking at a number of things, whether it's putting off discretionary hiring, whether it's seeing other cost cuts that we can put in place. They're not going to stop traveling. They're not going to stop getting out on planes, but they, like other airlines, like JetBlue, they're looking at their schedule right now and they're saying, A, do we keep it in place? You know, JetBlue's already said that they're going to cut schedule by 5%. Or in the case of Southwest, you look at it and say, look, we're going to hold for now, but if these bookings continue to be as far down as they are, at some point Southwest may have to cut its schedule. So it's a fluid situation, Kelly, but one where the airline industry is looking at this saying, we don't have any guidance in terms of when things will stabilize with future bookings.
Hey, Phil, it's Tim. How about, are they discussing, or, this is naughty stuff, but how about lowering prices? And again, as airline investors, we worry about two main things. We worry about capacity because airlines have never had the discipline before. And we worry about revenue per available seat miles, or RASM. So what do you think on this?
I put that specific question to Gary Kelly, and he says, nope, we're not going to be cutting our airfares, nor does he expect the industry to go on a big airfare discounting schedule. He believes that, generally speaking, the airlines first will move towards cutting schedules, meaning basically cutting frequency. Instead of 10 flights a day for United or American between Chicago and New York, they may go down to 8, may go down to 7. They do not think, and this is Southwest and other airline executives, they do not think that this is a case where people will say, you know what? You drop the fare down to $19, yeah, I'm going to get back on the plane. What they're seeing is it's not financial. It's a case of, especially on the corporate side, corporations telling their employees, you're not going to a particular event. And that's why they are not looking at this and saying, let's just cut fares dramatically.
Yeah, and that's why, again, he says no point cutting the price if no one will get on the plane anyhow. Phil, we appreciate it. Phil LeBeau, Tim, just want to mention, as we see now, United's down 10% with American. If you're an airline investor.
Yeah, I am. And
still today?
I'm long Delta. And here's something that people probably don't want to know. And here is there airlines which have been re-rating gradually for the last 5 years. Certainly they did kind of 3 years ago into a sideways track. And if you look at Delta just on the charts, you've had a range somewhere between 48 on the downside and 62. And it's been a very tradable range for the last couple of years. It's broken through those ranges. And if you look, Delta to me is best of breed. It's certainly got the best balance sheet. It's got the best financial discipline. They had no max exposure.
Berkshire agrees.
They've got a brand. And I think you want to buy it. This chart has broken below what has been at least 2 or 3 year support. And that's, I don't trade on technicals solely, but it's a guidepost and it's something to think about in terms of timing when you put a trade on.
But in other words, a guidepost that says to you, hey, this is an opportunity, or hey, watch out.
Both. That I think that Delta is on valuation very defendable here, although that valuation probably changes in terms of their profitability in the short to medium term. But that chart has me a little concerned in the short term. I want to watch that.
All right. Ahead on Power Lunch, we're still monitoring the sell-off. The Dow's down more than 1,000 points right now, and more than 50 S&P stocks are hitting new 52-week lows. Plus, OPEC reaching an agreement for a big production cut, but energy stocks are down 30% from their recent highs. Will this help relieve the pressure? We'll discuss when Power Lunch returns.
And now, the latest from tradingnation.cnbc.com and a word from our sponsor. In navigating markets,
green is the theme across the board.
What signs point to opportunities?
Gold hitting a near 7-year high.
In economic political crossroads,
Global slowdown grows. Central banks are feeling the pressure.
How do you brace for the risks ahead?
Debt levels in the world are rising.
Set your money on track with Nancy Hungerford and Tanver Gill. Get up to speed with the day's biggest moves, real-time updates, actionable insights, street signs on CNBC.
CNBC brings you conversations with the world's greatest minds. From the world of politics.
We are not going to pay any single cent for such a stupid war.
To the boardroom.
Failure is not the opposite of success, it's a stepping stone to success.
And royalty to Hollywood royalty.
I want to give a cultural face to older women.
The biggest topics and the biggest names, all on the CNBC Conversation.
CNBC Events. The power of our newsroom live. In person. An exclusive invitation. To connect. Seek out new ideas. New opportunities. Share your perspective. Spark your imagination. Join us. CNBCEvents.com.
Weekdays, Kelly Evans connects investors to newsmakers, stirs up high-stakes debates, and digs behind the numbers. Strengthen your investing strategy on The Exchange. Weekdays on CNBC.
Start on top of the news. Global markets ahead of the game.
Time for this morning's big money stories.
Brian Sullivan, Worldwide Exchange on CNBC.
Here's your CNBC News update this hour. Former movie mogul Harvey Weinstein's being moved from a hospital
to a jail at New York's Rikers Island. Weinstein has been in the hospital since he was convicted of rape. Weinstein's sentencing is scheduled for next Wednesday. The Director General of the World Health Organization is urging nations to redouble their efforts to fight the coronavirus and telling them this is not the time to give up.
This is not a time for excuses. This is a time for pulling out all the stops. Countries have been planning for scenarios like this for decades. Now is the time to act on those plans.
Health officials are also trying to allay fears that pets can catch and spread the coronavirus. This after a dog tested weakly positive, that's their words, in Hong Kong. Officials say it was likely due to contact with its infected owner. The World Health Organization says there's no evidence that dogs can become infected or transmit the virus. Still, Hong Kong officials recommend that owners avoid kissing their pets because, you know, they don't want the pets to get it from the humans. We're the problem. You got that?
Kim's got it. Contessa, thanks very much. Contessa Brewer. We are near the lows of the session. The Dow is down about 1,000 points. The S&P and NASDAQ also tanking today. In the Russell 2000, the small caps getting hit the hardest. There's a look at your screen there. Russell 2000's down about 3.9% right now. NASDAQ's down 2.9%. We'll call it the outperformer. But it's all eyes on the 10-year yield today, hitting record lows earlier in the session. It went below 0.9%. We're just a hair above those levels right now, 0.926. And oil closing lower despite OPEC looking to secure a 1.5 million barrel production cut. The deal is conditional on one country in particular fulfilling its end of the bargain, and that's Russia. Brian Sullivan has more.
Yeah, so OPEC met today, the OPEC Plus tomorrow. Much different meeting, no meeting. I'm sitting here. I'm not in Vienna. They have a deal in principle. It's not a deal. It's a proposal to cut 1.5 million barrels a day more than they already are. They're 2.1 off their quota. So that'd be a 3.7 million barrel a day.
Expectation was 1 million?
I mean, 1 million was like the, if you don't do a million,
got it.
Look out below.
Safety cut.
If we don't get Russia to join on to this 1.5 million, look out below. Because from what I've going back and forth with people at the meeting, there is no plan B. So if Russia does not get on board, most traders I talked to this morning suggest we could end tomorrow in the high 30s for oil. In other words, oil will tank tomorrow unless we get that
What's
deal.
What's the read on what Russia wants? Anybody know?
What do you tell me? Look, I was the guy that lived in Russia for a couple of years.
What does Vlad want?
Well, I mean, in terms of production and in terms of swing capacity and in terms of a budget break-even, Russia needs this cooperation more than anybody. Historically, Russia's been a little bit more tactical, but the cooperation between OPEC and non-OPEC over the last 3 years has been almost unprecedented. So
it is, and it's the new OPEC, really. And by the way, Ecuador quit today, OPEC, so maybe Russia could take their spot. Because remember, Russia's not a full member. Russia's the kid that wants the cake and eats it too. You live there, as you said. They want higher prices, but they don't want to be the ones to cut production. And remember, Alexander Novak, who's a very nice man, I've talked to him, the Russian sort of energy minister, he calls Vladimir Putin. He's not making the decision himself.
This is the state enterprise. So the question is really also on compliance, though, because Saudi Arabia seems to be the one that has to eat essentially all of what is non-compliant and do it for the entire group. And at some point, I realize they're transitioning to a 2030 economy that's away from oil and gas. But right now, they're nowhere.
You remember Oprah Winfrey, and you get a car, and you get a car, right? It's OPEC. You're going to cut, and you're going to cut, and you're going to cut. Because you're right, Saudi Arabia is the only one that seems to bear this. They've got a new energy minister, one of the sons of the king, a lot more powerful in many ways politically than his predecessor. He doesn't want to have to eat all this. But remember, Libya's gone. They're pretty much offline. Venezuela's one ship a day at this point, if that. And by the way, they got piracy now. The one ship a day that's leaving is getting boarded by pirates. Had a captain killed a couple weeks ago. That's how sad the situation is there. So bottom line is this. No deal tomorrow. Possibly look out below for oil prices and these beaten up oil stocks.
On that note, Brian, stick around. We're going to be joined now from Houston by Andy Lipow. He's president of Lipow Oil Associates. Andy, what do you think of what Brian just said? No deal tomorrow, look out below. And how far down is below?
Well, I agree with Brian completely because that's my feeling. If OPEC does nothing, that's the nightmare scenario for them. And the first stop is going to be a WTI with a 3 handle on it. and you know, could go down
It's
to
going to be
$35
WTI,
a barrel.
right? Yeah. I mean, it could really fall into the 30s,
Exactly.
you think? Yeah.
Oh, yeah, I don't think there's any doubt, because the demand destruction that we're seeing out of China over the last couple of months is 3 to 4 million barrels a day. And the deal that they're talking about right now is only to increase production cuts for 3 months till the end of June 2020. And they have said nothing about extending the cuts that they implemented back in December of 2019. So the world happens to be quite awash with oil due to this demand destruction. At the same time, that oil production continues to increase, although at a slower rate in the U.S., but as well as in Brazil, Guyana, and Norway.
Yeah, Guyana's a big story, by the way. I mean, they've got an election there. Hess, they've got a huge operation there with Exxon, and that's been one of the bright spots. Andy, is there any indication that we're starting to see production finally start to slow in the Permian Basin and the Eagle Ford Shale?
Well, I don't think we've seen it quite yet. We've seen it, say, in the amount of drilling rigs that have been taken offline, but we still see increases in oil production. You saw that in the latest EIA stats, where production in the U.S. rose to 13.1 million barrels a day. I guess the good news for the producers is we now have all this pipeline infrastructure to deliver it to the Texas Gulf Coast and make its way into the export market.
Well, maybe good news for those producers, but it goes back to the oversupply issue that's dogging.
Well, yeah, listen, before the December OPEC meeting, I came on and I said, OPEC is our friend. For 40 years, OPEC was the boogeyman. Widely hated, right? 4-letter word. OPEC is our friend. I know it sounds weird, but if OPEC, because they are, you know, sort of a cartel, if they can get prices up, that's the best thing that can happen to some of these beaten up U.S. producers.
Yeah, absolutely.
One of the Andy, real quick, is the CapEx hole that this industry either is going through now or will soon face, is that ultimately the best news for prices, though? I mean, and how long does that take? Because the industry has not been reinvesting in itself, and at some point, that's an issue for supply.
Well, it's probably going to take 12 to 18 months to see it on the supply side, but there is no doubt that CapEx is being cut drastically as we speak. In fact, I believe Exxon just came out and said that they're cutting down and slowing down their drilling in the Permian Basin as well. But the fact is that every time OPEC acts to reduce supply and prices rise, these producers in the Permian Basin just get antsy and want to drill another hole in the ground and get more oil out.
All right, Andy, we're going to leave it there. Andy Lippau, we thank you. Brian, great to have you with us as always.
And all but 2 S&P sectors are trading more than 10% below their recent 52-week highs. As leveraged industries feel the pressure, do investors need to worry about a potential credit crunch? Power Lunch is back in 2.
Today's Forex Update is presented by Interactive Brokers. 125 markets, 31 countries, 24 currencies. Today's Forex Update was presented by Interactive Brokers. Gateway to the world's markets. One world, one account.
Interactive Brokers charges 3.06% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 7.82% at Fidelity or Schwab to as high as 8.5 to 8.75% at Ameritrade or E-Trade. Move your account to Interactive Brokers and save at least $4,700 or much more if you're trading big bucks.
Back when the first forecast started coming out of 2020 demand, how it would be impacted by the virus, we're seeing estimates of maybe OPEC estimated maybe about a 250,000 barrel per day demand hit. The IEA was a little more bearish, seeing a 365,000 barrel per day hit on oil demand growth, but still growth this year. Now we're starting to see some of those forecasts go, like I said, turn negative. And so we're actually potentially going to see a contraction in oil demand growth.
What we say is, based on the facts on the ground, containment is possible. However, the window of opportunity for containment is narrowing. So, side by side, we need to prepare for a potential pandemic. That's why we're asking countries to really be more aggressive in containment interventions.
Opening bell action and reaction.
Global markets under some pressure this morning.
The first trade.
Financials are the best performers right now.
The first analysis.
Is there a risk here? Look at these stocks.
Squawk on the Street. Weekdays on CNBC.
Welcome back. More and more companies are warning the coronavirus outbreak will hurt their bottom lines, including those carrying heavy debt. And now top credit agencies are starting to sound the alarm. Steve Leisman is here to explain.
Kelly, thanks. Top executives at all three major credit rating agencies, Moody's, S&P, and Fitch, tell CNBC they're closely analyzing the potential effects of the coronavirus on corporate, municipal, and sovereign debt. Moody's says, quote, definitely something that we're monitoring very closely. S&P says there will be more ratings actions and the pace will quicken as a result of the virus. S&P already has changed 27 debt ratings, including 7 downgrades and 15 companies placed on negative credit watch, all related to the coronavirus. The debt's attracting the most scrutiny. Airlines, some airlines with weaker balance sheets, other companies in travel and tourism, they downgraded Samsonite and Sabre. Put them on credit watch, and countries that rely on those revenues to service their debt. Commodity companies also being watched carefully, along with countries that rely on commodity revenues to service their debt. The main worry, not investor grade at this point, but speculative debt and highly leveraged corporate bonds, and that should raise a red flag for investors that are going down the credit ladder hunting for yield. Fitch writes, as the virus spreads to other economies, including the U.S., a greater number of leveraged corporates may find their production disrupted and their revenues pressured. We're a long way from the type of debt meltdown that marked the financial crisis, but for some individual companies and countries, probably not so far away from debt downgrades by the rating agencies.
But there's probably an important distinction to draw here. Anytime markets are freaking out, we use terms like credit crunch, which is there's a difference between the quality of the credits in the market and the ability of companies to access credit in the market. So you're talking about the former, not the latter. In other words, you're talking about
at this point,
the quality of those companies
at this point,
not necessarily
right.
whether there's enough liquidity in the system.
There's a lot of debate, and I'm sure Tim can talk about this, Kelly, about what liquidity is. But more than anything else, it's a state of mind. Liquidity is available and plentiful until it's not. And that's why we have to be careful. It's why investors should just be careful of things that are too good to be true. A massive dividend yield of 7% should raise a red flag. It may be a great bargain.
Yeah, I totally agree, especially on equities. I mean, the massive dividend yield equity companies, the Macy's of the world, are companies that are largely broken. All it takes is one bad day, and back to liquidity, Steve. I mean, this is a Wall Street dynamic too. I mean, think about the liquidity and the dealer community and the balance sheets. They're no longer putting balance sheet at work every single day. So when you call up your dealer and you need a quote in a difficult market. 15 years ago, you got it. And, they widened out the bid ask, but now it's, hey, we can work that for you. But in some level, even some lower high grade stuff on a difficult day is treated almost like by appointment. And that's very challenging in this environment.
You have to be, on the other side, what the debt agencies have told me is that, look, you have credit, you have interest rates coming down. And while spreads come up, interest rates come down, that does ease the cash flow. Also not crazy to think that, for example, some sovereigns might be eligible for bailouts. They mentioned me the Maldives as a low-grade credit that is substantially reliant on tourism dollars.
Do we need to go there, by the way, just to make
we may have to go check it out. But the IMF and World Bank have put out the welcome mat for countries to come to them to help with their sovereign debt. There could be other bailout programs that may rescue other companies down the road. It's got to be very careful about which are the weakest ones. And the other problem, Kelly, is that when stuff like this happens, you find out basically where bodies are buried. Who holds the debt? Who holds the risk? And is that person or that entity able to hold the risk, or are they also stretched out?
I've also just heard, because the covenants were written so loosely, I guess we should say, for years, that it's probably the case that when defaults happen, they're going to happen because there literally isn't cash flow to make payments.
Muhammad El-Arian is worried about the result of many, many years of light covenants and plentiful and cheap money, and finding out just how light those covenants were.
And fallen angels. I mean, those are the ones that are the biggest risk that people don't expect.
All right. Steve, we appreciate it. Steve Leisman, thanks very much. Still ahead, shall we?
Let's
over to
move on.
Ty.
It's been a wild week for the Dow, it says right here. 1,000-point moves, higher, lower, in between. What does all this volatility mean for your 401k and your savings? We'll hear from one of the nation's largest retirement planners after this.
The countdown to the close of the US markets is sponsored by IG.
This has become very personal, it seems. Why won't you resign?
Walking away does not solve the problem. Walking away could cause more uncertainty and confusion.
It's been a very brutal 7 months, and you personally must have suffered immensely.
The most difficult part is to see this city that I love has sort of suddenly changed to a place where people have lesser respect for the rule of law. Society is so divided.
The situation, as I can see it, has been stabilized, but of course the long-term solution will have to come from government to resolve some of the underlying issues.
You actually, as a bank, hadn't seen any signs of physical transfers of cash away from Hong Kong.
We saw a few clients who made arrangements. Truly no money changing hands.
Your CEO has, in recent days, talked about economic devastation.
Our trading volume did take a hit. Hong Kong needs to get our story out, need to tell people that we are open for business.
This is where you want to be, where front row seats stretch from coast to coast.
And he buries it.
The excitement drives connections and fuels the celebrations. Big wins and bigger moments are setting the stage for the don't blink, can't miss next stop in the race for the FedEx Cup.
The overnight action.
About 0.25% higher for the Dow.
Unscripted debate.
One more story. Looks really boring on the surface, but it's not, and I'll tell you why.
Where is the opportunity for our investor? Europe free trade.
European futures this morning looking to recover some territory.
And real-time action.
Is that going to be the driver of deal-making through the rest of 2020?
The starting point matter in 2020 when you're looking at the stocks.
Squawk Box. Weekdays on CNBC. In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation, and startups from one place. CNBC.com/technology.
Well, 1,000-point swings in the Dow nearly every day the past 2 weeks, putting investors on edge as, again, markets sink back into correction territory today. Almost everyone feeling it in their 401ks and IRAs if you have dared to look. But our next guest is Empower Retirement CEO Ed Murphy, says his customers are showing remarkable resiliency. Empower handles retirement accounts for more than 9 million Americans. Ed, welcome. So when you say resiliency, I assume you mean they're hanging in there.
They're hanging in there.
They're not acting rationally.
Irrationally. No, we don't see that. What we see is inquiries up. So our call volumes are up 15 to 20%. Activity on the web using mobile devices is up. But there's no capitulation. You know, people are calling to get account balance information. They're calling for reassurance. But we're not seeing really an increase in trading activity or flight to quality.
Are most people in their 401ks sufficiently diversified, or are they overconcentrated?
I would say they're sufficiently diversified, Tyler, in the sense that a disproportionate amount of the flows and the investments are in target date funds, and that's a multi-asset structure. And so they've got exposure to fixed income, they have exposure to equity. And so from that standpoint, we're seeing people well diversified.
Are the target date funds working as they theoretically are intended to?
I think to some degree, yes. But
that's a fairly faint praise there.
Well,
it's okay because 100% of my money's in it. So.
Well, no, let me get, here's my perspective on that. You and I can both be age 40. You're willing to take risk. I'm not willing to take a lot of risk. You're healthy. I have cancer. So longevity is a factor. And we get placed into the same target date fund. So I think where the market's going is to more of a personalized type structure that takes into consideration some of these critical inputs. And that's what we're working on, frankly, with several asset management firms.
And obviously not all target date funds are created equal. There can be 40-year-old target date funds for 40-year-olds that are more risky than others. So you got to know what's in your fund, as you always do.
That's exactly right.
Yeah.
The other thing I would say is increasingly what we're hearing from the nearly 10 million Americans that we work with is they're looking for advice. And whether that advice is embedded in a product or whether it's delivered by a human being, they want to turn it over on a discretionary basis.
Not to belabor the point on target date funds, but it's always stuck in my head that there is an implicit promise in those funds that if I'm a 40-year-old and I put my money into one of these target date funds, the amount is going to sufficient to support me in retirement is going to be there.
Well,
period.
Certain things are explicit too, right? In terms of there's some protection on the downside. There certainly is some upside. But I think the question ultimately is, have these folks been in a bull market for so long that you talked about that lack of capitulation? Does that worry you?
And you've got 12 seconds.
Yeah.
It does worry me, but I think that the industry's done a really good job in reassuring investors that this is long-term money and that you shouldn't react emotionally to the swings in the market. That is really, for the most part, it is long-term money, and you get the benefit of dollar cost averaging and reinvesting.
And we have to leave it there. Ed Murphy of Empower, thank you very much.
Thanks everyone for watching Power Lunch today.
Closing bell. Watch the next hour. We'll be here tomorrow.
Welcome to Closing Bell, everyone. I'm Sarah Eisen on the floor of the New York Stock Exchange. Another major sell-off on Wall Street. Volatility continues to shake this market. I'm here at the post of Royal Caribbean. Stock is down 16%, tracking for its worst day since 2009. Also, you can see Carnival and Norwegian down double digits. Those three stocks, the cruise lines, the worst performers in the S&P 500, 59 minutes left of trade.
And I'm Wilfred Frost. Good afternoon to you. Let's have a look at what is driving the action. The spread of the coronavirus continues to dominate headlines, with travel and aerospace stocks particularly suffering. Bonds surging, yields making new record lows today as the 10-year fell below 0.9%. And OPEC backed its biggest output cut since the financial crisis, dependent on Russia's approval. Energy, though, still one of the worst performing sectors today. Coming up in the next few minutes, we'll discuss what this all means for the retail sector with NRF President Matt Shea, and we'll dive into tech valuations with legendary tech investor Alan Patrikoff. That's all to come. Joining us for the full first hour of the show, CNBC contributor Stephanie Link, along with CNBC senior markets commentator Mike Santoli, who's here as well. Mike, quick first question to you. We're down 1,000 again as we approach the close. Interesting to me, though, is the fact that week to date, only 3 sectors are in the red. And again, a big sell-off today, but off the back of a strong Monday and a strong Wednesday.
Week to date, the S&P 500 is up a couple percent.
Yep.
So the overall market is up. And fascinatingly, even though we've had these massive daily moves, today was basically just within yesterday's range. Yesterday was within the prior day's range. I'm not saying that's going to continue and we're going to continue narrowing from here and all of a sudden the storm has passed, but it really is the market fighting to figure out the same set, wide spectrum of outcomes. Today, what's really notable, though, is the cyclical areas of the market getting brutally hit. And so we're really essentially pricing in a steeper slowdown today. It's not really just, those big tech stocks that were up a lot. It's pretty much the cyclicals today.
What do you do on a day like today?
Stay calm. I mean, the day-to-day action it's staggering to me, guys. And I think much of it is algo driven, quite frankly, because I don't know very many people.
4% moves, 3% moves.
Yeah, and I think 1%, you break 1% in the 10-year, and all of a sudden another algo's hit, right? So I'm not saying that no one's doing anything, but a lot of people that I talk to aren't doing very much, and whatever they're doing is kind of slow picking away, and that's kind of what I'm doing, because I don't think we're out of the woods. The volatility is going to continue because we do have so much uncertainty, not just about corona, and oh, by the way, we get more tests next week. There's going to be more cases, and people are going to be nervous, but what the implication is to earnings, to the economy, we can't model out that, and that is something that as an investor is very challenging. So what I'm looking at copper, which actually has stabilized. I'm looking at the 10-year, I'm looking at gold. When those things kind of start to act better, I'm actually going to feel a little bit better. In the meantime, what I said last week is I'm kind of quality upping my portfolio.
Like what?
I bought United last week. I bought, because it went, we talked about 300 to 250, Nike 104 down to 85. I bought AbbVie yesterday with a 5.1% dividend yield. I bought Zoetis, which hasn't come down at all, and I'm hoping it's going to come down because it's the best animal health care company out there. And I bought some Wells Fargo at a 5% dividend yield, which is staggering to me. So I'm looking at opportunities. These are all going to go down if the market goes down, but I'm hoping that they go down less, given that they've already pulled back.
United,
so much.
You said United Health. United Health.
Yeah,
Okay.
no,
Not United Airlines.
Oh, God, no. I'm not touching an airline. Not right now.
All right, we'll talk about that later. We are all over this massive sell-off on Wall Street. Full team coverage of the final hour of trade for you. Bob Bassani, biggest movers on the floor. Rick Santelli on those drop in yields. Mike has the market dashboard. Meg Terrell monitoring latest developments with the coronavirus. And Phil LeBeau is in Washington as airline executives gather for a summit. Bob, first to you, though, on the floor.
You know, there's a lot of debate, Sarah, about whether this is a demand issue with parts issues around the world or supply, just reduced consumer demand out there overall. And I think we've answered that thing. This is a supply and a demand issue. Demand is clearly decreasing on the consumer side. Take a look here at Live Nation, not just cruise lines, but look at Live Nation here, down 8%. This is a 2-year low for Live Nation. Madison Square Garden also has been down rather dramatically. Got concerns here about sporting events and concerts being canceled. Look just above that. I'm going to show you that the banks are having the same issue, and really for the same reasons. This is Comerica, down 7.5%. This is a 4-year low for Comerica. Other banks like M&T, big regional banks, 4-year low. U.S. Bank Corp, new low. Wells Fargo. And I know it's very easy to say, oh, it's because of the lower yields. Yes, but there's a lot more here going on with the banks. They're dealing with the potential for lower loan demand. They're also dealing with the potential for more loan defaults. These are very important components. So this game is not just about yield. And I think, guys, we've settled on the supply versus demand story. It's definitely both going on here. Back to you.
Bob, absolutely. We're going to talk more about the banks a little later in the hour. Meantime, the 10-year falling to a record low. Let's get to Rick Santelli at the CME. Hey, Rick.
Hi, Wilf. You know, twos right now are only down 10 basis points. 10s are down 12. All maturities are finding a little bit of lift. Look at a week to date of 10s. Notice that Tuesday's extreme of 0.9 was violated. We've been talking about that. But here's something interesting. A week to date of 30s, the 150 on Tuesday has not been violated. The low has been 153 ever since. Something to pay attention to with regard to, are we all alone in this dynamic of flight to safety, which might not be safe? No. Look at a 20-year chart of gilts at 33 basis points. You're not going to find a lower one. It's historic. Let's look to Canada, our neighbors to the north. Their 10s at 85 basis points. There's a 20-year chart. You're never going to find another one. The point is that the dynamic isn't so discriminating as to be telling us about our economy. It's telling us about where people are running from and where they're running to. Sarah, back to you.
Quick question, Rick. I mean, the plunging bond yields, at what point do you think that can act as stimulus for the economy? We see mortgage rates, for instance, now plumbing record lows. But where else should we be looking for an impact, if at all?
Well, I think everything that is out of control has a positive side to it when things settle down a bit, whether it's lower yields, although, unfortunately, the big boys of the world get to take advantage of them, the average person, through mortgages maybe, even maybe car loans, but they correlate, but there's a big add-on, there's big haircuts to most of that. I think energy is the other extreme. Everybody's looking at the sector, but the average middle-class person is going to be able to fill up for less, and maybe if they're not so panicked about going outside, they'll drive more and use more energy.
All right, Rick, thanks. Let's go back to Mike Santoli. Today's market dashboards. Mike, what have you got today?
Yeah, Sarah, obviously investors trying to navigate these big swells and breakers in the market, really these kind of violent waves. Take a look at this chart. Goes back to June of last year. This captures, I think, a lot of the relevant areas that we've kind of gone through right now. So this big vertical, near vertical drop, and then this very jagged attempt to put in some kind of a very short-term low. It kind of brought us back to these areas, right? The lows of the summer, when the low 2800s on Friday we hit there. So we've been kind of trying to see if this is going to be a cushion for the market. Back then it was only like a 6 or 7% pullback. The pullback wasn't a big deal, but we were in panic mode to some degree about a recession coming. So we've unwound that entire lift that priced in some kind of an economic reacceleration. Look at this chart though of calendar year 2011. The day-to-day action is very similar. A lot of the stats that are generated in the trading dynamics are taking you back to this period in August and October of 2011. We had the potential of U.S. debt default, sovereign debt crisis in Europe. So there, vertical move, just as I showed you on the other chart. And then this very jagged attempt, right? Violent rallies, massive sell-offs, in successive days. We eventually did kind of retest and go down through the August lows in October, then finally had a recovery into 2012. I will say, valuations back then were much friendlier. It was, we actually cracked below 11 times forward earnings on the S&P for a while. Bond yields much higher. So there was a little more play in terms of the buffer for valuation, but also I think less confidence in the bull market in general. So I do think that's decent context.
I mean, Mike, in terms of that comparison though, 2011, we had way bigger questions being asked about the future outlook than we do now, or so far than we do now.
Yes. Well, you would think, right? Is the United States going to default on its debt?
Well, much
the
more.
Eurozone going to hold together?
The Eurozone country's going to default.
Things. Absolutely.
Yeah. And in that sense, what we've seen over the last couple of weeks is aggressively more pronounced than anything we've seen before relative to what's on the cards.
Well, and maybe the valuation levels we're at right now explains that, but also the inability to really handicap the range of outcomes, I do think is significant at the moment. And again, I keep pointing to the 9/11/2001 scenario as well, where arguably you also had much more existential issues on the table.
I mean, earnings are uncertain, but the multiple's already contracted to two multiple points from its high, from the beginning, from the all-time high.
What do you think Wall Street wants to see? Do you think they want to see the tests in this country ramp up so we get a better feel for the numbers we're looking at?
Yeah.
I mean, that feels like a key uncertainty right now.
It is a key uncertainty, and I think if we get it starting next week, is that the peak of bad? And once we kind of get familiar and comfortable knowing that it is the peak of bad coronavirus, then we can actually start to try to model. Because right now there's no way. That's why I'm buying on
the other thing people just don't know, and I don't know that the health experts have a good answer at this point, which is how long is this going to last? Right. Does it go away in the summer? How long is this with us? Because Ed is another huge uncertainty where it would be impossible to model earnings and economic shocks.
Right.
Well, the other thought is that the formula for making sure we limit the spread is to curtail lots of economic activity, and for everybody to essentially panic and not consume and travel and everything else. If that's the way around a wider outbreak, that's your other hit to the economic outlook. You have to factor that in.
Or to put it a different way, Steph, what would make you start to buy more meaningfully? Would it be if rather than being 10% from the highs, we were 20% from the highs? Even if that happened today and we haven't got the answers to your questions on testing and data of the virus, would that be enough to step in?
Some of the stocks that I'm buying are down that much already. So yes, of course, if the overall market was down that much, my bet is that the cyclical sectors are going to get cremated, and they might be down 30-40%. And then you're yielding 4, 5, 6%. Again, if they're strong balance sheets, I'm in there picking because I'm long term. But I have cash, guys. You can't go all in because you just don't know. But again, the duration is going to be important, and whenever we get comfortable with the peak of the coronavirus, the numbers here in the States, I think that's going to be the sign.
Think about yesterday.
Remember, just hold on for a second. Just look at China. The Chinese market was down 14% for January and early February, and then it bounced up another 14%.
I don't know if we can we trust that?
Well, I don't know. The FXI is green today, which is astounding to me on a day where we're down how much, right? So it's.
I'd like to know if people were allowed to sell in China, but we don't. Look, the rest of the world's been outperforming the U.S. as we described this week. But I do think you have to think back to yesterday, and there is a scenario under which the impact is relatively brief and modest. We don't, if you want to bet on that, be brave. But I'm just saying, you're going to have days when the market's up 1,000, and it's going to be because people have decided to look at the market and say, maybe overestimating.
Well, and the other thing is on the other end, I mean, that's why I asked Rick about low yields and how they can be stimulative for the economy. We have that set up. We have central banks now going all in to try to prop up economies, even fiscal policy in places like Italy and China. And so the setup for when this is passed would look strong, I would think.
Absolutely. And I think that we talked about it last week. Lower interest rates benefits housing, benefits the consumer. Lower energy prices benefits the consumer. Consumer 75% of the U.S. GDP. Jobs are still plentiful for now. Wages are good. So the consumer is still okay. I'm not kind of whistling past the graveyard thinking that they're going to stay super strong. Obviously, you're going to see a pullback, but I still think it'll be the engine for the economy.
Also, not sure that we're all in yet on fiscal policies. China, yes, on all levels, all levers being pulled. But Italy, 3 billion, great. 8 billion here even, not going to do much. I think we're a long way from being all in on fiscal policy and to the level we are monetary, certainly. Let's get to the numbers as it relates to the virus. Meg Terrell, as always, has the latest for us. Meg.
Hey, well, we're just getting new numbers from Seattle and King County, one of the U.S. hotspots for the virus. 20 new cases reported there, bringing the total to 51 and 1 additional death. In New York, case numbers doubling overnight to 22. New Jersey and Tennessee reporting their first cases, and Illinois reporting its 5th. Some of these cases are still related to travel to other affected countries, but a growing number have been detected in the community. Total U.S. cases now approaching 200 in the U.S., and worldwide case numbers topping 97,800 with more than 3,300 deaths. Work does continue to move quickly on a vaccine, with Kaiser Permanente Washington announcing it's begun enrolling patients in the first COVID-19 vaccine trial. Now, this is the vaccine developed by Moderna with the NIH. Kaiser saying the site will enroll 45 healthy Seattle area adults between 18 and 55 years old. Guys.
Meg, is there anything we can learn at this point from South Korea or Italy as it relates to some of these questions we're trying to tackle on the desk? Where this is going, how long it's going to last, and how bad it's going to be?
Well, those last few questions are things people are still really trying to get a handle on, but there are things we can be taking away from South Korea and Italy right now. It's been something I've been digging into today. South Korea's death rate is very low right now, and a lot of people say that's because their testing is huge. They've tested more than 140,000 people, so they're probably picking up more mild cases and people in earlier stages of their disease. So as that progresses, you could potentially see the death rate rise there as people progress through it. In Italy, we are seeing a higher death rate. A lot of folks say that speaks to the underlying causes of severe disease, including age. This is hitting an aging population in northern Italy, and that may be contributing to the higher amount of deaths we're seeing.
Meg, as always, thank you very much for that. Still to come here on the closing bell, retailers are facing both supply disruptions and demand weakness from the virus. We'll get a read on who's suffering the most and who's prepared to weather the storm with National Retail Federation's Matt Shea.
Airline stocks remain under tremendous selling pressure today. Phil LeBeau tells us how the coronavirus is hitting the industry. Phil.
Sarah, when you take a look at what's happening with the airline stocks, they're all under pressure today, mainly because, as Stephanie pointed out earlier, she's not touching it as long as people do not have any certainty about when bookings pick up. Good example of this, Southwest Airlines. We just talked with Gary Kelly earlier today. Today they warned that their first quarter revenues will take a $200 to $300 million hit. 2 weeks ago, just 2 weeks ago, they were expecting to have strong growth, including strong revenue growth in the first quarter, and then they saw a big drop-off in bookings. Here's Gary Kelly.
End of last week, we started seeing very sharp declines. Of course, you know, the stock market really reacted last week, and we had cases showing up in the United States. So not too shocking that we'd see some impact on our bookings.
As you take a look at a number of the airline stocks today, all of them under pressure. Why? Because nobody's quite sure how long this fall off in bookings will last. Is it going to last through April? Will it last into May? I've talked with a number of CEOs today here in Washington and yesterday when they were at the White House, and nobody has any guidance at this point. One other interesting note about the meeting at the White House yesterday, guys. Eamon Javert and I have talked with a number of sources who have indicated that following the meeting of the CEOs with the coronavirus task force, a number of CEOs pulled aside or had meetings in the hallways of the West Wing with leaders of the Trump administration, and they pressed them, the administration, to look for those opportunities where they can reassure the public, especially corporate travelers, that it's okay to get back out on the road. Because that's what we're noticing here, guys. A number of the business travelers, a large percentage, are now saying, I'm not making a particular trip. Not because they don't want to go, but because their company has said, nope, you are not making this trip. And that's why you've seen a severe fall off in bookings. And again, nobody's quite sure how long it'll last.
Phil, just going to mention where session lows down more than 4% on the S&P as we speak. So clearly, Phil, a fall off in demand. They started to see that last week, as we heard from Gary Kelly. What about in terms of their supply? What sort of percentage of total routes and flights have they started to cancel? I feel like that's still relatively low in percentage terms. And then we saw some numbers. Lufthansa and British Airways parent company, they seem to stand out that the European airlines have cut a lot more than the US have so far.
Right, because they're farther along in dealing with the coronavirus impact than we are here in North America, Wilf. You had United yesterday saying, we're bringing down our international schedule by 20% in April, the domestic schedule by 10% in April. JetBlue will be cutting its schedule by 5%. We expect to see this with a number of carriers. Gary Kelly said he wouldn't be surprised if they have to make some reductions on their schedule. What's interesting to note, when you talk with the CEOs, they do not think that we will ultimately see a fare sale, if you will. In other words, throwing out, hey, $49 to go from Chicago to New York. We want to fill the planes. They look at this purely as a demand issue. Not the same as what you might see during a recession where people pull back on their spending. They look at this in terms of people either being afraid or being told not to make a trip.
I think it's interesting that there's an aviation summit when a lot of other corporate events are being canceled all over the country from other industries. I guess they're trying to make a statement, Phil.
They're not too worried. Not one person that I talked with said, I was thinking twice about coming here. And that you will not find anybody in the airline industry. I mean, they're conscientious of what's going on, and they understand why people might be concerned about going to big events, but they are not going to be changing their patterns of work travel, at least not the way we've seen with other industries.
Also, slightly dated propeller as the backdrop behind you there, Phil, as well. I thought we were on to jets these days.
There's a few of them there.
Phil, thank you.
I'll pass it along to the event organizers. You bet.
Yeah, and coming up, we're going to talk more about this with former Continental Airlines CEO Gordon Bethune. He'll join us with his take on coronavirus and how airlines should be responding to this crisis.
We have just over 4 after the session. We are at session lows, just fractionally off them, but down more than 4% for the S&P and the Dow. The Dow in point terms down 1,098. Sector heat map for you. All of them negative today, and comfortably so, albeit, as we mentioned earlier, only 4 sectors are negative for the week as a whole, and they tally with the 4 you're seeing at the bottom of the performance for just the intraday. Thing to point out, really, financials, energy, they're the worst performing sectors since the start of this big corona-related sell-off, and even on the up days, they have bounced the least. So both of those two sectors very much in bear market territory, down 20% from the highs. Financials down 5.7% as we stand.
Yeah, industrials down 5 as well. Let's turn to retail. Evercore ISI out with a note saying TJX, that company is one of the best positioned retailers to weather the coronavirus storm. The firm says that the company is an ultra trifecta that creates significant value for suppliers, consumers, and shareholders over the long term. That stock getting hit with the market down 4.5%. Meanwhile, the S&P Spider Retail ETF on pace for its worst day since August, its second negative week in a row. Let's bring in Matt Shea, President and CEO of the National Retail Federation. Matt, thanks for joining us. You're constantly in touch with retailers across the country. What are you hearing from them in terms of level of concern about consumers going out and spending?
Sir, nice to be with you. Thanks. So we've been doing, really, our primary role as an association is to convene retail industry leaders. We've done that regularly over the past few weeks. In fact, we had about 7,000 visits to our website yesterday. We got a very robust information page with updates on the coronavirus on nrf.com. We did a call last week. We had several hundred retailers on with Dr. Nancy Messonnier of the CDC. And we've been sharing information and trying to exchange best practices. And I think it's been talked about a couple of times here. On the supply chain side, a variety of the companies we're talking to have given us indication that in many cases, their factories are back online, and they may not be at 100% capacity, but I spoke to someone in Hong Kong yesterday, major supplier, said 90% of their factories are up and running. They may be 30, 40, 50% capacity, but they're coming back. So the supply chain issue for many companies might end up being weeks rather than months. And, I think Stephanie got it right a little bit earlier in the segment when she said the big unknown here is the uncertainty about what this impact will be like. And if we can inject some certainty about that into the market, I think people are going to feel a greater sense of calm and ease about what happens next.
Matt, on the demand side, if we put aside the likes of the sort of hand sanitizers and Clorox wipes, do you get a feeling that this isn't totally lost demand and it just shifts between online and offline, or are we going to see a big drop-off across the broader retail sector?
Well, that's an interesting question, and we've asked it both. Talked to probably 24 CEOs in the past week, and we're also out in the field talking to consumers about that. And so I'll give you the CEO perspective first. Talked to a CEO of one brand in a certain category 2 days ago, and said, they're feeling some impact in that segment. And talked to another CEO yesterday morning, and he said, well, let me give you the other side of that trade. We're actually doing very, very well right now. So I think obviously you're going to see consumer spending shifting among certain categories, certain segments of the industry, and maybe even shifting among channels. And I guess that brings me to what consumers are telling us. We're out in the field with a substantial survey that went out earlier this week, and more than 85% of respondents thus far have told us they have not changed their shopping at this point in time, and that's only a couple of days old. And more than 80% indicated that even if this gets worse, they won't spend any less. So I think that suggests, sort of what you're inferring, that at the moment they're saying even if it gets worse, they won't spend less, they might spend differently, different channels, different segments, different products.
That is not what we're getting from the market, Matt. I mean, if you look at some of these big, sharp moves in some of these retailers getting slammed, and how about the mall-based retailers or the department stores, which were suffering before the onset of this coronavirus news started to spread? And what do you tell companies like that right now?
Well, I think the way to look at that is the way we look at other challenges and disruptions that have occurred across the industry over the past few years. And that is that, a strong economy is not distributed equally across all companies and doesn't result in equal levels of success for everyone. And so even in certain categories, in certain segments that might appear to be more or less challenged than others, there are going to be winners and losers. And when this ends, and this will subside, and we don't know when that'll be, and that's what's creating the uncertainty and the volatility, but when it does end, those companies that are well positioned will be even better positioned than their competitors. And those will be companies that have put in place strong engagement strategies, that have thought about investing in digital, that have put a real premium and an emphasis on supply chain fulfillment. And supply chain fulfillment's not about suppliers exclusively, it's about data. That's what drives supply chains and fulfillment. And they have the right executive team and the right vision for their brand. Those companies will take share away because at the moment we're in an environment in which people are taking share from others. So if we look out across the next year, if there's not robust growth, it'll be about capturing share from competitors. And those stronger companies will end up and emerge even more strong than they are now.
Matt Shea, thanks so much for joining us.
Thanks, Will.
Tonight, don't miss CNBC Special Report Markets in Turmoil, 7 p.m. Eastern Time. Another massive move.
35 minutes left in the session. 30 out of 30 Dow stocks lower, and the overall average down 1,100 points. Time now to get word on the street. Credit Suisse out with a note today saying General Mills and Campbell's Soup are well positioned for pantry loading and recession risks on coronavirus fears. It's estimating that over 80% of Campbell's portfolio is geared toward pantry loading. The technical term. Campbell's CEO Mark Klaus joined us yesterday on Closing Bell just to talk about all of that. And here's what he said about the impact.
We made the decision last week to begin to up production in certain areas where we're using a little bit of the analogy of weather or natural disasters. Where do we see demand coming in at a greater rate? And we've upped that level of production to be able to maximize our inventory.
Shares of General Mills up more than 7% in a week. Campbell up 15%.
Needham lowering revenue estimates on Alphabet, saying coronavirus will cause less search ad spend on travel, which would have generated around $1 billion per month for Alphabet before the outbreak. Needham also says that since search ads have the highest gross margin at Alphabet, 2020 operating income and EPS results will be impacted. The stock's down 6% today. Deutsche adding Ulta Beauty as a short-term catalyst buy idea, saying the beauty industry is largely insulated from coronavirus concerns as brand partners mostly manufacture in North America. Deutsche says Ulta's domestic-only store network is also outside of major tourist centers. The stock, though, down 5.6%. Any of these stand out to you, Stephanie? I mean,
yes. Yes. First, Mark Klaus is a rock star. He was at Pinnacle Food at Campbell. He's done a great job of turning around the company so far. There's a lot more they need to do. But he was a captain in the Army, and he's worked in the business for a very long time at Kraft. And then Pinnacle, sold Pinnacle. So I go with him for sure. And I know the stock is up a lot, but it's only 20 times for a staple in a turnaround mode. I like that one a lot. Ulta,
But the question is this pop?
There's a lot they're doing. So maybe the pop short term certainly could be the pantry loading, but I think there's a story here. And so this is a perfect example of what you want to buy if this thing is down 5 or 6 or 7% tomorrow or the next couple of days. The only other one I would say that was interesting on this is Ulta. I mean, I'm itching to buy it, but this trades at 22 times forward. It has no yield and it has high beta. So I believe in the company and the turnaround there, and they're doing a really good job in the skincare. We saw it with Estee Lauder. We saw it even with the department stores that skincare is very good. They've got to fix cosmetics, but at 22 times, it's going to move much more than the market. So this one I would be much more patient in.
I wonder if, and we were just talking to Matt Shea about the retail hit that could be coming. I wonder if companies that have more robust and established online businesses will do better. And and whether investors have figured that out.
I went on Amazon to buy Clorox wipes today. It's going to take me a week to get them, but at least I ordered them. No, I do think you're going to see a lot more.
And also, I think it's the bullish call on TJX. I mean, yeah, sure, they have a model that's sort of resistant to being displaced by online, but that's because people go and browse.
Yeah.
I mean, it's the whole strength of TJX is not exactly a strength at this moment. And I also think the whole buy canned goods short cruise lines trade looks really stretched in the short term. So it just seems a little too easy and obvious.
Well, that's what you said about Zoom Video, and then sold off hard after earnings.
Still to come, by the way, we will talk about potential buy the dip opportunities in the tech sector with legendary VC investor Alan Patrikoff.
30 minutes of trading. If you're just joining us, another massive sell-off on Wall Street. The Dow is down 1,000 points, and it's odd. We're getting sort of used to these 4% moves in a day. Yesterday, the Dow closed up 4% on what we were calling the Biden bounce. Now, Corona fears back in the spotlight. In terms of who's getting hit the hardest, UTX, United Technology, Boeing, JP Morgan, Exxon. So it's that triple sort of cyclical thing of energy, financials, and industrials, which are bearing the brunt of the selling.
Just want to point out, because it's the worst performing sector today, financials. The KBW Banks Index moments ago was down 7%. 7% for a basket of 40 to 50 bank stocks. I mean, that is extraordinary. The reason I sensationalize that a little bit is they haven't enjoyed the bounce either. So this isn't like we're saying, oh, but week to date, this is still a sector that's higher. Banks are down about, the KBW Banks Index now is down about 23-24% from its December high, down more than 20% from its February high, which was less than a month ago. So these guys haven't really enjoyed a bounce.
People think it's 2008, and these companies are different than 2008 in terms of their balance sheet and their capital levels. So that's why I was buying a little bit of Wells, because it is yielding 5%. It's one that I actually feel pretty confident in that yield. I don't know the bottom, and I don't want to own a ton of banks within this yield curve environment, but at some point you're going to have a bounce. And I think these stocks will eventually recover.
I think there's an element of people thinking it's 2008. I think there's another element, going back to your point earlier, Stephanie, you're saying there's a lot of machine-driven selling, that the correlation with interest rates is very high. I'm sure many algos are programmed to say, oh, if the 10-year dips below 0.9, let's sell some banks again. And the correlation of that has held up a lot on the way down.
Overall market down 1,040 points. Here are three things driving the action in stocks lower. The spread of coronavirus continues to dominate headlines, with travel and aerospace stocks particularly hard hit today. Bonds are surging. Yields are making new record lows today. 10-year yield below 1%. It's at 0.9%. And OPEC backed its biggest output cut since the financial crisis, dependent on Russia's approval. Energy is still one of the worst performing sectors, so not doing a whole lot to help those battered stocks. Business Roundtable also just announced the formation of a task force to coordinate action between the private sector and the government. It will be chaired by Marriott CEO Arne Sorensen and Union Pacific CEO Lance Fritz. It will include Jamie Dimon, the CEOs of Pfizer, NASDAQ, J&J, Home Depot, CVS, American Airlines, United Airlines. Also, the BRT announcing it's postponing its CEO Innovation Summit, which was expected to host a few thousand attendees, but will continue with its regular scheduled quarterly meeting later this month. CNBC can report HHS Secretary Alex Azar will be attending that meeting. So clearly companies trying to get on the same page with the government, because we've heard so much about how companies are being more conservative, say, than the government in terms of telling their employees to travel and canceling conferences and that sort of thing. No, they have legal responsibilities too. Nobody wants to get blamed.
I am hearing a lot more intra-U.S. the bans, not just international, starting to see don't travel at all. I don't know, that's probably getting priced into airlines at this point.
We are down 3.7% on the S&P at the moment, a little bit off the lows of the session. Let's go back to Mike for another installment of the Dashboard. Mike.
Yeah, well, asking if we need a bigger boat looking across the asset markets, looking specifically at credit, which has largely been spared up until this point, but it's starting to flash some signs that maybe it is weakening. Here's basically a chart of the prices, the ETFs of high yield bonds and then intermediate term treasury. So it's a proxy for high yield credit spreads. What you're really seeing is most pronounced, obviously, this furious rally in treasury prices, therefore the drop in yields. Now, the prices of high yield bonds have softened up and they have turned south, therefore the spread's wider, but it's mostly happening because of the treasury yields going lower and credit yields not following them. So right now you're basically saying it's something to be concerned about. We don't know if it's really going to morph into greater stress. Some stocks of highly leveraged companies today are getting walloped for some of these concerns, but it's anticipatory. However, look at the yield on investment grade debt right now, very long term, going back 10 years. It's around 2.3% right now. That is very undemanding of investment grade companies. So if that's your hurdle rate for investment, issuing debt, buying back stuff, doing whatever, it's a very low one right now. And at least in theory, if things calm down, it could support both company balance sheets as well as share prices eventually.
In the very short term, Mike, this week, what's happened to credit? I mean, it's
weakened. I mean, the spreads are out, but it's not necessarily even back to where we were like in the fourth quarter of 2018 in terms of high yield spreads, but it's also not far from there. So I do think we're in that zone of nothing as bad as early 2016. But since then, it's getting toward the upper end of the range in spread.
Thanks, Mike, for that. Stocks have improved, by the way. The Dow's down less than 1,000 now, 3.4% or so. It has, of course, been a very volatile week for the Dow, swinging more than 1,000 on Monday to the upside. Down almost 800 on Tuesday, back up another 1,000 on Wednesday, and today falling another 1,000 at the lows just off that at the moment. Our next guest says if you're a long-term investor, you should be buying on the dip. Alan Patricoff is the chairman of the venture capital firm Greycroft with $1 billion under management. He currently has investments in the likes of Axios, The Skim, and Wondery, to name but a few. And his exits in the past have included Huffington Post and Health Plus One. Alan joins us right here on set. Good to see you.
Nice to have you. Be here with you on this wonderful, exciting day.
Thanks so much for joining. I mean, let's help.
Not feeling so wonderful.
The headline point.
Well, I'm excited. I'm excited for the Biden success. So that's a successful.
Well, maybe
day.
we'll come to that as the factors behind the market move. But if you're a long-term investor, you're actually think this is much more something that creates opportunity than should create fear.
I learned a long time ago from a very astute person in the market, and he said, if you love a stock and you really know the fundamentals, if it goes down, not that you want it, if it goes down 50%, you should love it twice as much. And that concept has stuck with me for a long time. If you have a company that you really like or that you know, I certainly would not be afraid about dips, but I think for the moment in this very volatile market, I would be staying very calm and not doing anything, frankly. But I think the opportunities are going to be here. We've been there. If you saw the New York Times last week, they had this incredible graph of the last 10 years of stocks. And it went just like this. And then at the last 4 days were like so small. And it was in the context of a 10-year cycle of ups and downs. You know, this is a blip. And we've seen a lot of blips in the last 10, 20 years.
What's it done to your market, venture capital, private equity? Do you get to see lots of opportunities to buy companies? Are they strongly correlated to what's happened in the broader indices or not really?
Well, we're investing in young companies. It's not correlated. It's interesting, the companies you put up there before of ours, Wondery's in the podcast business, the Skim and Axios, everybody keeps reading every day. Companies like that do well. Companies that relate to staying at home and not having to go and travel, I think are going to do fine in spite of this blip. But I think we shouldn't get overly nervous by what's happening, although no one likes to see declines like we're seeing. But when you're seeing volatile markets up 1,000, down 1,000, the best thing to do is just to keep your money hands in your pockets for a while.
You say it's a blip. I mean, why are you so confident that this couldn't be or cause a more prolonged economic downturn?
Listen, I saw the 70s, I saw the 87 blip, I saw the 90s. There's always something that dramatically happens, and I think we're going through. This is a serious. There's no question about it. But I think that if you hold on to good fundamental stocks, I certainly haven't sold any stock I own in the last several weeks.
So what are you looking for to get more confident? I understand you want to buy, but you're not right now. So what will it take for you to buy?
I think we need to see things settle down. I think what's happening in the political season picture is I think will help. I think once that stabilizes and we got into a more normal environment, which I think we're headed into, I think that's going to be a stabilizing force. And I just think general economics in terms of what, thank God, most major companies are in good financial shape, and that's a very important fundamental. We didn't see that in 2008 because there were some really bad balance sheets around.
I know you focus more on the earlier stage companies, but you know tech incredibly well. Did you think that tech stocks had got a little bit overstretched to the upside coming into this, and in that sense, is the pullback we've seen actually quite understandable?
Well, I think you would have had that kind of some modest pullback no matter what, because things hadn't gotten ahead of themselves. And I think we are going to be going into an environment of anti-competitiveness. I think we're going to see the Googles and the Facebooks. There's going to be a lot of congressional scrutiny, and I think where those companies stand vis-a-vis all the other smaller companies is going to be seriously considered by the Congress and also by the public, and probably during this election cycle.
Hey, Alan, venture firm Sequoia, one of your competitors, sent out an email, I guess, warning some of its founders and CEOs of a worsening economic condition and having them start to ask questions about COVID-19, about headcount, about being thrifty with marketing expenses.
I have to smile because, and I'm not at all critical of that statement, but I remember very clearly, I can't remember what year it was, that Sequoia put out the same kind of letter. You should go check
2008 RIP, good.
Yeah, they did exactly the same thing. But we all say to our companies.
Turns out in 2008, that was a prudent time.
I mean, right now you should be make sure your balance sheet's in good shape, have cash in the bank, and keep your head count tight. But I think you have to look on a long-range basis. I think what they're saying is anyone who's a rational business person wants to make sure their house is in order. And
but
not
it sounds
just
like you're not sending that to your companies like Graycroft.
Well, yeah, we're saying that to them every day. We didn't just all of a sudden say it the last week, but yes, we would reinforce it. Make sure you've gotten your costs controlled, because everybody is feeling the after effect of this. Except I heard peanut butter sales.
Do you think that it's going to be hard to exit any of your current early stage investments via IPO for the rest of this year because of the current environment?
I think for the near term, I would think IPOs depend on market windows. I said this, I think, on this program a few months ago. People try to catch a window when it opens. The window hasn't opened the last couple of months. I don't see it opening here in the next 3 months. We've got to get through a much more settled period. I mean, you can do lots of quiet filings, but I think to come out into this environment, you got to be pretty gutsy.
M&A as well. Any exits by M&A do you think also are going to be put off for quite some time?
Well, we have, without naming them, we have a half a dozen that are in process. I haven't heard anything, certainly in the last week, that would indicate they may not be, that they shouldn't continue, and they're at, prices that are appropriate, and we have every confidence they're going to be completed.
Sorry, Alan, just reading through the Sequoia post. They're calling it the black swan of 2020. You think they're too worried?
No, I don't. Listen, this is a, it's been described as a pandemic. I mean, this is, I just heard, it's only a rumor and I'm not saying it's true, but some universities are saying to the kids, don't go home for college, don't go home for spring break, stay in place. Because people are trying to, contain everything where it is. And I think meetings are being canceled, and this is going to affect, the travel companies. It's going to affect everybody. Fortunately, our younger companies are in such a high growth mode that maybe instead of growing 100%, they'll only grow 50%, 60%, but as long as they've got their...
But that's not a blip. I mean, you said it was a blip in the market.
Well, what I meant is that I don't see this being the next year going straight down. I mean, I just don't see it. I mean, I think we're going through a period of time, and we're going to go through an adjustment. And this is good. I'm not a health expert, but I would say we're going to see this thing settle down probably the next 2, 3, 4 months, whatever it will take. And after that, we'll see a recovery, and we'll be sitting here a few months from now and watching people getting themselves back in shape. In the meantime, it's uncomfortable. It's no fun.
Well, we hope you're right, Alan. It's always a pleasure to see you.
Good. Thank you.
Look forward to that conversation in 2 or 3 months' time. Alan Patrick.
Thank you for having me.
And by the way, don't miss CNBC's special report, Markets in Turmoil, tonight, 7 p.m. Eastern Time. Coming up on this show, we're going to talk to a technician, Tom McClellan. He'll tell us what he's seeing in the charts amid today's big market sell-off.
Let's have a quick check on shares of Zoom Video. That stock considered a coronavirus beneficiary, video conferencing company, of course. It's up 5% today. It fell last night following earnings, but of course is up hugely year to date, some 70% or so. Casino stocks performing much worse in the broader market today, as they have done of late. Contessa Brewer has the details for us.
Wilfred, Nevada is reporting its first case of coronavirus. It's a man in his 50s who has a child enrolled in Clark County schools, according to the health department. That has hit the state's casinos especially hard. Let me show you El Dorado now. Off more than 15%. Red Rock off 14.5%. Boyd, that's the regionals, the locals casino. MGM Resorts taking it on the chin. And the worries about how this coronavirus outbreak affects consumer behavior and conferences is also driving down. Say, for instance, Penn, which is down almost 13%. Las Vegas Sands, again, gets most of its revenue overseas, only 10% from Las Vegas. So it's faring much better today. Wynn is taking it on the chin as well. SunTrust reports that room rates in Las Vegas are taking a leg down as well. And there's been some question about this deal that's pending between El Dorado and Caesars, as El Dorado is launching its debt capital raise on March 23rd. Sources tell me the funding commitments are in place and that credit will not be an issue there. So we should see that moving forward here. Perhaps a deal would get done mid-April, Wilf.
Contessa, thank you so much for that. We have just under 15 minutes left of the session. Here's a check on the closing bell. Big board. The major averages, as you can see, are down significantly, but just off the lows. We're down 3.6% on the S&P 500. You're looking there at the biggest Dow laggards, McDonald's, Cisco Systems, American Express, to name but a few. Couple of banks thrown in there. They're slightly odd order for you. From United Health and Boeing, down 6.8%.
Steph, last chance trade time. What are you going for?
I'm going for quality. L3 Harris. So that is the combination of L3 and Harris. And I owned this stock last year, and it was a wonderful performer. I took profits. The stock is now down 10%. Why do I like it? It's a special situation story. Basically, they have synergies between the two companies, and there was obviously some margin upside as a result of that. But there's also free cash flow generation that's going to improve this year and the next several years. They're guiding $3 billion for 2022, and I actually think they're going to be able to do that earlier than expected because they're making so much progress. They're going to then buy back 5 to 7% of their shares outstanding. So I like this. It's really kind of immune to coronavirus issues.
I think you should explain what they do. We don't talk about them that often.
It's a defense contractor, right? Sure. And by combining the two companies, they actually are a more formidable competitor to the big guys, right? So they're going to gain market share as well. And as I say, they have margin upside not only from the synergies, but also as they build their market market share against their competition.
We have 14 minutes left of the trading day. We're now in the closing bell market zone. Commercial-free coverage of all of the action heading into the close.
CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've got CNBC contributor Stephanie Link here as well. Let's kick things off with markets. Stocks plunging lower today as the 10-year Treasury yield hits a new record low. DoubleLine Capital's Jeffrey Gundlach appearing on CNBC's halftime report earlier today, weighing in on what he predicts the Fed will do next in response to any slowdown caused by coronavirus.
I think they cut 50 at the next meeting, and in just 2 weeks. I think that's going to happen. I don't think we'll go to negative rates. I think Jay Powell understands that negative rates are fatal to the global financial system. If we go to negative rates, there will be capital destruction en masse.
Gundlach predicting another 50 basis point cut. That's pretty much where the market
is. He's
is.
predicting what the market's been saying.
Yeah,
I mean, that's essentially what's going on. Now, could it change within the next couple of weeks, I suppose, but if you look at the 2-year note yield below 0.6%, when you have a federal funds rate at, 1% at this point, so that's what it's telling you. Essentially, the market has rushed to that place.
People are starting to contemplate zero. I haven't heard a lot of negative, but
the market's implicitly saying if the economy sags, it's pretty much a trip to zero over some period of time. Whether it's true or not, that's what the market is braced for.
And look, this is not going to fix coronavirus, right? But it is signaling at least that they're moving at a faster pace, and hopefully it instills some sort of confidence. Clearly, the move this week didn't really, because you had market up and then market down. But I guess another 50, I think, would say they're moving quickly to do whatever they can do, and then you see what happens on the news on the virus front.
I think it helps to weaken, or at least the Fed would hope maybe that it weakens the dollar a little bit, which puts a little pressure off the rest of the world and a little pressure off our exports, which the president wants to see, but not for necessarily that reason.
Dollar is certainly weakened because the only thing I'd say is correlation between, certainly applies to the banks, which we're about to talk about, but broader markets with yields is high. So another rate cut, does it drag markets at least in the short term?
Well, the correlation with market-based yields is definitely high. So the market usually gets there first. The Fed is following. I don't know if that relationship is going to be one for one. What I'll make a couple of observations about today is the 10-year note yield made a new low. The S&P 500 did not. It's still held above the levels from Friday. I don't want to make too much of it. I'm going to stick with my plan all week for not extrapolating a single day's move and saying this is somehow decisive about how this correction goes. But the lows for the S&P over the last several days, 29.77, 28.55, 29.45, 29.76. We basically kind of settled back into that same zone and then refused to go lower. I don't know if that's decisive. I probably doubt it is, but it's telling you that the bond market and the stock market have gone some distance into pricing in a dimmer scenario.
So what is your pick as far as sectors for a low-rate world? Right now, it's utilities that are faring the least worst in terms of the action. I think they're having their best week ever.
Yeah, I know.
They were on top yesterday as well when the market rallied. So where do you want to be for the low-rate world?
I mean, in a low-rate world, you do want to be in some of the defensives, utilities, some of the REITs, some of the staples. I think of those three, I prefer the staples. At least there's a consumer backdrop in those, and they're not as expensive. They're expensive, but they're not as expensive, and those on the pullbacks are where you want to be. But I have to say, I'm not all in on defensives, guys. I can't be, because there's too much value being created on the cyclicals. I get why you don't want to own them now, but that's why I'm looking at yield. I'm buying some high-quality companies with good balance sheets in the cyclical areas. We talked about Wells Fargo. I've mentioned Caterpillar. Wrong on both of them so far, but I do think a year from now, I will be right.
Well, let's talk a bit more about the banks. Of course, another torrid day for them because yields have been falling. The KBW Banks Index now down 23% from its December high, down over 20% from its February high less than a month ago. Clearly, as we've discussed often, falling yields not good for the bank's earnings and certainly not good for their share prices because of the very strong correlation we see between rates and bank stocks. But just wanted to flag some recent work on valuations that's been done. Autonomous research working out the impact on provisions, fees, costs, capital, earnings, etc., and therefore what it means for valuations under 3 different scenarios. Currently, before the last 2 days' moves, stocks are on an 8.5 times price to earnings ratio. Autonomous say if we see 100 basis points cut in total, i.e. another 50 basis from now, they'd be on 9.2 times PE. And if we see a full-blown recession, the group would be on 15.6 times PE, i.e. cheap relative to the market in all of those scenarios. Another measure of their value is, of course, dividend yield. Most of the banks, the big banks, now have a dividend yield of over 3%, Wells Fargo over 5%. One big question always when we say about dividend yielding stocks is, will the dividend have to be cut? For banks, the answer is almost certainly no. Why? Because they're in fact returning well over 10% to shareholders, the rest being buybacks. If they were going to cut any of that, it would be the buybacks that are cut. The dividends, therefore, are very safe. Now, clearly, the group, though, not trading like some of those safe, high-yield sectors like utilities and staples that Sarah just mentioned, though they share some characteristics. And Mike, we know they're going to trade in line with yields,
yes,
but actually they're yielding some pretty good dividends themselves.
They are, and you know, one other way to look at them is to look at the actual debt of the financials, and it's not raising any alarms right now. It trades very tight just because they are so well capitalized. So all that stuff creates a buffer. I think it's one of the ways the market is now kind of forcing you to say recession or no, right? If you think recession, then today's sector breakdown is the way it'll go. It's defensive, and it's, you know, puke out the transports every day. If it's no, then all of a sudden banks and cyclicals are starting to say they're in the zone of that they're over discounting something.
And it's interesting that thesis is being drawn not from economic data, which continues to look pretty good. I mean, claims were not a problem today, jobless claims, but the anecdotal look, if it's going to hit cruise lines and airlines and business travel and events and concerts and malls, and it starts to pile up in terms of the damage that this is going to do to the economy.
And that's why I go back to how comfortable are you with the consumer? How much do they actually pare back? Because we know businesses have already pared back. They haven't even contributed in CapEx for years, right? So it's going to be the consumer and how can they hang in. Back on the banks, though, for a second, I'm waiting to see the alts actually come in, like a Blackstone. Apollo's down 11. Blackstone's up on the year. Those benefit from low interest rates. And so those are the ones that actually you may want to be picking at along with some of these other beaten down banks.
Just want to quickly end with a 5-year chart of Bank of America, because this is a sort of bear case if we're being a bit crude on the fact, which is go back to 2016 when people were thinking, oh, we're in a zero rate environment forever before rates started to rise, and we have a long way to go to get back down to that. So if you're just being very simple, very crude, that investors are thinking, oh, rates are going to zero, banks aren't going to be able to make money, whether it really affects their EPS or not, if that's how people are thinking, there's a long way to go. But clearly, you know, they are making a lot of money and the dividends are pretty strong.
They are, but their yield is 2.7%, as we talked about. Some of the others are a lot higher, so I'm not sure people are going to gravitate. Plus, you know this, that they are the most exposed on the yield curve. So, I mean, I think there's going to be a point where you really do want to back up the truck, but maybe just wait a bit on that one.
One stock that's actually bucking the trend today is Kroger. That stock hitting a 3-year high after reporting a beat on earnings, also a beat on sales for the quarter. Kroger reiterating their guidance despite the coronavirus outbreak, citing Kroger's limited supply chain exposure to China and saying it's too early to measure how it will affect their business overall. Basically, they kept guidance without the big boost that the Wall Street is expecting as a result of corona. Here's what the CFO said on the conference call. In the last few days, customers are spending more on water and hand sanitizer, soap and paper, and boxed dinners. The company also has rationed the number of certain sanitation and flu products from online orders, guys, limiting to them to 5 per person. So clearly the view here is that names like Kroger and Costco is going to report after the bell are going to get a tick up in business, though executives were key to play it down on the call because, you know, they want to show they're in the middle of a nice turnaround and they're starting to show results. The Restock Kroger program, sort of similar to what we heard from Campbell. They don't know how long this is going to last.
I know, but at least they had better comps, better ex-fuel gross margins were the real highlight, to your point, and I do like the turnaround story there, but, you know, my heart is in Costco. It's way more expensive and it worries me more on valuation, but I got to think they're a huge beneficiary as well.
And in general, the market's not going to pay up for front-loading purchases, right? You're not using more paper goods because you bought a lot today.
Although Costco was up 10% or 13%.
That's what I'm saying. So the market actually usually is not going to pay up for valuation, but it's a harbor in this kind of market.
But also you could argue that if you go out just to hoard toilet paper, you're also buying groceries and everything else in the store.
And you're not going out to eat as much.
And that's not that's a recurring purchase. Food goes bad.
Meantime, the energy sector getting hit hard, down more than 19% in just the last month. Our own Becky Quick sat down with Exxon CEO Darren Woods moments ago, and they discussed the coronavirus's impact on oil.
We've got to take a very long-term view, and the investment cycles that we make are anywhere from 5 to 10 years, and so our strategy in laying out our plans is to make investments that are robust to these down cycles, and so that you can ride through them. We've got a key competitive advantage with the balance sheet, and so we build these advantage investments that are robust to the down cycles, and then we use our balance sheet to kind of ride through these turbulent times. The economy, I think, over the medium to long term is going to continue to grow. So the demand for energy, which is closely linked to economic growth, is going to continue to grow.
Mike, to the point about the two worst performing sectors of late, banks and energy. Banks aren't anywhere near their 2016 lows. Energy very much is.
It very much is, even though, crude oil prices are not, and it's been the pattern all along. It seems as if almost anything that comes along is an incremental reason to lighten up on energy. And it's difficult to see in this environment when so much of the world is essentially operating on a slow speed or stall. At this point, I mean, the commodities keep piling up. It's just difficult to work your way through that in terms of sentiment.
Oil down again despite the OPEC action. Mike, you've been looking into the market internals here. 2 minutes to go, down 1,000 points.
Yeah, another lopsided negative day. If you look at up-down volume on the New York Stock Exchange, it's another 90% down day, pretty much, give or take. So that's multiple ones we've had recently, very much like that 2011 period. Utilities against industrials. Same story we've been talking about. Of course, transport's a big chunk of the industrials. That's showing a wide divergence on the day. The volatility index has popped back above 40. That's probably an uncomfortable spot for it to be in, even though the market's above its lows. That's pretty much at the closing highs or so. So that still shows you a bit of a hazardous market out there.
All right, we are just under 2 minutes to go. Let's head uptown to Bertha Coombs at the NASDAQ. Bertha.
Yeah, Sarah, we are seeing here in the NASDAQ falling back into correction, negative for the year, but for the week still up. And that's because a lot of the big caps are still holding onto their gains over at least the 2 sessions that have been up so far. Zoom is seeing a big reversal here during the day. The stock disappointing in terms of the company's outlook for more business as a result of coronavirus. Nonetheless, they are higher. And take a look, a lot of these video chat companies are moving higher this week as well. Over to you guys.
Bertha, thanks so much for that. I'm here on the floor of the stock exchange as we approach. It goes 1 minute left. We are down 3.3% on the S&P 500. That is well off the lows, which was down more than 4%. Regardless, another massive day of selling here on Wall Street. Yields have played a big part. There's a snapshot. 2-week chart of the 10-year. We've gone from 1.4 to below 0.9, but the yield itself is off the lows, and that has helped stocks as we approach the close. Here's the worst sectors: banks, energy, as we've just been discussing, continuing to suffer. The defensives like utilities, staples, and healthcare, the best performing. Bob Pisani joins me here. We're going to flip to an intraday chart of the Dow as we discussed. But Bob,
here's the story. We've had a lot of debate about whether this is a V, a U, or an L-shaped recovery. Obviously, the market's telling us it's not going to be a V-shaped recovery. Think of the demand destruction. Think of restaurants. You're not going to eat twice as much if you go back to your favorite restaurant 3 months from now. Some stuff isn't going to come back, Will.
Well, some of us will, but I take your point. We are down 3.5%, 967 points on the Dow. A little bit off the lows, but nonetheless a massive absolute move to the downside once again. Sarah, back to you.
Nice rally.
Another big sell-off here on Wall Street. Welcome, everyone, to Closing Bell. I'm Sarah Eisen. Wilfred will be rejoining me from the floor in just a moment. I'm here with Mike Santoli, as always, CNBC Senior Markets Commentator. Take a look at how we finished up the day. Another massive move lower for the Dow, down 972 points, 3.6%. For the S&P 500, 3.4%. It was broad. Every single sector finished in the red. Groups like financials got crushed, down 5%. You had the real cyclical trades, those that are tied to the fate of the economy. They did the worst today. Financials, industrials, and energy. Take a look at the NASDAQ, faring a little bit better than the other averages, but still, big sell-off there, down 3.1%. The Russell 2000 index of small caps also getting swept in with all of the selling. Bond yields hitting new record lows. There's the Russell down 3.4%. This comes after a day where the Dow jumped 4%. Crazy action, extraordinary moves. Transports falling to a new 52-week low today as airline executives meet in Washington to talk about the coronavirus. And coming up, we will talk to former Continental Airlines CEO Gordon Bethune on the state of the sector. Joining us to talk about the market today and what to do next, Liz Ann Saunders, Chief Investment Strategist at Charles Schwab. Michelle Meyer is here, Head of U.S. Economics at Bank of America Merrill Lynch. Still with us is Stephanie Link, CNBC contributor. Though first to you, Mike, on another just stunning move in stocks.
Yeah, every day this week, the S&P has moved at least 2.8%. It's alternated up versus down, mostly 3 and 4% moves. And as extraordinary as that is, it's not necessarily unusual after the shock and the fastest 12% drop from a record high we've ever had. It tends to be the way you go with these kind of low visibility, high emotion, kind of spring-loaded markets. I was just observed that we've tried to create this little bit of a lower end of a trading range over the last 5 days. So in the zone of S&P 3000 or a little bit below that, if you want to go on the assumption that that somehow is where you've had some buyers tried some things, that's fine. It's not decisive. As I said, we really can't kind of say until we've lived with this threat for a while and gotten a little more time in terms of metabolizing the threat of economic impact of the virus, it's difficult to have any confidence. But in terms of the market tactics and dynamics, this is what you get in the crucible of a correction.
Liz Ann, are we in screaming buy or screaming sell territory yet?
I don't think so. I don't think either technically or from a sentiment perspective, leaving aside the fact that we have no idea what the next month or two or however long it is going to result in terms of the impact of the virus on the economy, what the containment measures are going to be. You know, companies are withdrawing earnings estimates. They're not just guiding down. So leaving all those uncertainties aside, you know, it is a typical pattern if you are sort of finding a bottom, and I don't know whether we are, to have some retests, to see relatively weak breath on attempts at rallies, and then ultimately you sort of retest and you have a much stronger breath move on the upside. We obviously haven't seen that yet. I don't think we've seen a significant enough reversal in what was incredibly frothy sentiment that registered at the highs in January. So I think leaving all the actual factors that are driving this aside and just looking at your standard sort of technicals and sentiment, even there it doesn't quite look like we're there yet.
So add it all up, Liz Ann, and what are you guys at Schwab actually telling your clients to do right now?
Well, we haven't made any recommendation changes for the last 3 years. We've been, from a tactical perspective, what we call neutral to equities, which just means don't go above your normal long-term allocation to equities, and that's going to vary by investor in terms of how they're strategically positioned. We've taken a spread around that of overweight large caps, underweight small caps, and on a relative basis, I think that's still the way to go here. I think the profit fundamentals, the balance sheets, the percentage of zombie companies, I think is heavily still biased toward the higher quality, larger cap companies. But what we've really been on the table since early 2018 is, in this more volatile environment, be more cognizant of, number one, diversification across and within asset classes, and more systematic and frequent rebalancing in order to take advantage of these swings and kind of basically stay on the right side of the trade, so to speak. You know, trimming on the moves down to the extent it's been significant, or trimming on the way up and adding on the way down. It's kind of tried and true typical disciplines that we always espouse, maybe even more important in this environment.
Michelle, as a head U.S. economist, how do you try and gauge the impact on the U.S. economy? And roughly speaking, how much lower do you think it would be than it otherwise would have been?
Yeah, so obviously that's the big question, and every day it seems like we're learning a little bit more about how this might feed into the broader economy. So you first think about the direct hit, which is through a supply shock, and you can kind of gauge that. You can look at how supply chains are disrupted. You can get a sense of how production may or may not return, and you can understand a little bit about the business reaction. So that's understandable. You can pencil in the inventory drawdown. What I think gets a lot harder is around the consumer reaction, whether or not behavior is changing. And that can happen swiftly, and it could also happen driven by what's happening in the market. So if consumers are worried about their health, they're worried about their finances because of what's happening in the stock market, they start to become a lot more cautionary. They change their behavior, and you start to get an adverse feedback loop develop between what consumers are doing, what markets are doing.
Is that what you expect?
So So, no, I mean, I think we're seeing it a little bit. I think it's inevitable. But no, we don't expect to see, a real painful one that brings down the global economy. But I think at this point, there's just scenarios that we can play with. And we have to think about all these different linkages and be willing to adjust forecasts as we see the data come in, as we see that high-frequency data, which are going to be surveys and sentiment shifts.
Stephanie, where do you stand on whether the market's selling off because of fears of a recession or just wild swings in sentiment that move stocks, even if we don't think GDP is going to fall that much?
Oh, I definitely think there's fears of a recession because we can't model anything, as we've talked about last hour. Here's the thing, though, guys. The Dow's only down 8% on the year. The S&P's down 7.5%, and the NASDAQ is down 2.6%. It feels so much worse, though, right? Because of these major swings. And I think we talked about earlier, it's really more algorithmic related, and it's hard to get caught up in all of that. So that's why I have said many times, you don't want to go all in, but I do think there are stocks and sectors that are down way more than the averages, that have gotten punished beyond belief, that you have to take a stand, especially if they are blue chip, number one in their industry, and you're getting them on sale.
So just remind us what exactly you've been doing with that advice today.
So I have been picking, and we talked about some of the names that I've been buying. AbbVie was yesterday. It's yielding a 5.1% dividend yield. Zoetis is a name that I've never owned, that I totally missed, and it's only down about 7% on the from its high. So it's still expensive. That's one that I absolutely want to buy. It is the number one animal health company in the industry. Phenomenal management team. I am looking at some of the financials. The one area that I'm not really aggressive on. I'm not really aggressive on technology because those stocks are still up on the year. Some are up double digits. I know you want to own some growth, but I think you want to have those companies come down, particularly the FANG stocks.
Let's dive into the move in yields, which, similar to stocks, was large. Rick Santelli's got an update for us from the CME. Hey, Rick.
Hi, Will. You know, if you look at charts that start on Tuesday, here's what you want to watch for. There's the 10-year. 89 the low, 90. We took it down to 89 today. It's a tick or two above that. We violate that with the time remaining in the cash markets. That wouldn't be good. Unlike 10s, 30s have left their 150 spike on Tuesday unchallenged, and there's a bit of a cushion at 154. That's a good thing. Curve is flattened a bit today. And if we look at the notion, all our guests are so nervous about corporates, and I get it. But here's 10-year spreads by Barclays of corporate, investment grade, and high yield. And believe me, things could get worse, and maybe they will. But at this point in time, I'm impressed, very well behaved, considering they're measured against Treasury yields where the floors dropped out. Sarah, back to you.
All right, that's a positive sign. Rick, thank you. Michelle, I mean, you're an economist that works on a trading floor, right? So what's it been like on the rates desk this week as we've seen these new record lows after record lows in treasuries?
I mean, you can imagine the sentiment. It's a little bit of gasping. It's a little bit of where's the bottom? When do we get to zero? So you're starting to hear that type of conversation, which is how low can we go? And obviously the Fed cutting in emergency fashion by 50 basis points, signaling that there's more to come, market requesting that more should come, and the Fed not looking to disappoint markets. I think there's a view that we could see further capitulation, further drop in yields at some point. But people are also trying to think about what comes next, right? So is this an L shape or is it a U shape? You know, is there another side? And if there is, at what point does that become an attractive entry as well?
What's your base case?
So we think there is another side, right? It's probably a U. It's probably maybe it's a deep U. It might feel a lot worse before it gets better, presumably. But at the end of the day, it does seem more to be a temporary shock. The fundamentals of the economy were quite sound prior to the virus really hitting in a significant way to the global economy. So we are in the view that we will get to the other side of it. The question is when, and it might take some time, unfortunately.
So if you're expecting a U, do you not think the Fed cuts again?
No, I think they cut. I think
that's already priced into where yields
I think that's largely priced in. So I think they cut another 25 basis points at the upcoming meeting, followed by another 25 basis points in April. So that's 100 basis points of cuts. And then the view is maybe they've done what they need to do to stem panic, and you can start talking about more targeted fiscal actions, maybe some sort of joint work between the Fed and Treasury. And in a way, the Fed, I think, is trying to buy some time and hoping they can stem the panic.
What does that do to stocks if you get, 100 basis points? 100 basis points.
I think whatever it would do to stocks, it would do before the cut came. right? So I do think it's the conditions under which you're getting that cut. And if it, who knows, maybe 25 is a disappointment if that's all we get in a couple of weeks. I do think you have this very profound upside down situation where the federal funds rate for overnight money is above 1%, and almost no other yields in the world of any maturity are above 1%. So that's a part of what I think the market is trying to assimilate. What does that mean? Does it mean the Fed is implicitly too tight? I don't know.
Michelle, do we get to 39 on a PMI like China?
I don't think we do. I mean, for China, it was so dramatic. The economy shut down. Their factories shut down. It was an extreme set of quarantines. And so no, I don't think we get there here in the U.S. The other thing we have to consider in the U.S. is that we are somewhat a function of what's happening in China. And the fact that factories are starting to be a bit more, they're coming back, they're up and running, they're moving again. Product could slowly filter into the U.S. So I don't think the shock is as acute to the manufacturing industry in the U.S. as it was to China. But you should imagine, and we are forecasting we fall below 50 in those ISM surveys.
Lizanne, we've talked a lot today and the last couple of days about how energy and banks has suffered the most in this sell-off for understandable reasons. But have they got cheap enough to buy those sectors?
Well, we're making some adjustments to our sector recommendations right now. For lack of a better word, that means I'm kind of quarantined from talking about sectors. So I think that's clearly one of the reasons why small caps continue to underperform, because there is a much heavier bias within small caps to sectors like that, to financials and energy. So I think that ties into some of the factor-based performance numbers that you're seeing, whether it's growth versus value and large versus small.
All right, Lizanne, thank you. Another massive sell-off today on Wall Street. Dow closing down 969 points. Let's get back to Bob Pisani on the floor of the NYSE. Bob.
We are grappling with the extent of demand destruction we're going to see, but you see this in the travel and leisure industry. Look at Carnival Cruise Lines, 11-year low here. Some of these cruises are not going to be rebooked, even if it comes back in a few months. Live Nation, people aren't going to go to some of these